Welcome to Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. This audiobook takes you step by step through one of the most practical and proven approaches to understanding market cycles, timing your trades, and protecting your investments. Chapter 1. It all starts here. Every successful investor begins with a foundation. Weinstein introduces his core philosophy: the market moves in stages, and recognizing these stages is the key to profits. Forget guessing or chasing hot tips. The focus is on disciplined analysis. Chapter 2. One glance is worth 1,000 earnings forecasts. Here, Weinstein makes a bold statement: price charts reveal more than forecasts or analyst reports. Technical analysis becomes your compass. A single glance at a chart can tell you the story of supply, demand, and investor psychology. Chapter 3. The ideal time to buy. The best opportunities come when a stock breaks out from its base and enters stage 2, its advancing phase. Weinstein explains how to spot the right setup, strong price action, rising volume, and a supportive market trend. Chapter 4. Refining the buying process. Not all breakouts are equal. This chapter sharpens your eye. Weinstein shares tools and filters, like relative strength, moving averages, and volume clues, to separate true winners from false starts. Chapter 5. Uncovering exceptional winners. Some stocks don't just rise, they soar. Here, Weinstein reveals the traits of the greatest market leaders: strong fundamentals aligned with technical strength, industry leadership, and wide institutional sponsorship. Chapter 6. When to sell. Knowing when to exit is just as critical as knowing when to buy. Weinstein outlines sell rules to protect your profits and your capital, whether it's trailing stops, breakdowns from support, or signals of stage 3 topping action. Chapter 7. Selling short, the less traveled road to profits. Weinstein shows how to profit in falling markets. By recognizing stage 4 downtrends, investors can sell short with confidence, taking advantage of the downside instead of sitting on the sidelines. Chapter 8. Using the best long-term indicators to spot bull and bear markets. Beyond individual stocks, Weinstein tracks the big picture. He introduces long-term market indicators, such as moving averages and breadth measures, that reveal whether the tide is bullish or bearish. Chapter 9. Odds, ends, and profits. This is Weinstein's toolkit of extra strategies: managing mutual funds, short-term fund trading, and adapting his stage analysis to different markets. It's the same game, just with variations. Chapter 10. Putting it all together. The final chapter ties every lesson into a cohesive strategy. From recognizing market stages to spotting breakouts, managing risk, and staying disciplined, Weinstein's method provides a complete roadmap for thriving in both bull and bear markets. You've just explored Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. Remember, success in the markets isn't about predicting the future. It's about reading the present, acting with discipline, and always managing risk.
Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. Chapter 1. It all starts here. Buy low, sell high. That's the shortcut to a fortune, right? Wrong. It is just one of many loss-causing cliches that the crowd chants as they lose money year after year. There are many other do's on Wall Street that are really don'ts, such as the necessity of reading the financial pages and watching the evening TV business report so you are in touch with important developments in the economy and its leading industries. Or the need to get advice from a so-called Wall Street wunderkind who wears a 3-piece suit and talks to other wunderkinds. These aren't the answers, and they won't put profits in your pockets. It's unfortunate that so many investors embrace these ideas as the key to financial well-being. Buy low, sell high is a cliché, not a blueprint for action. It blinds investors to the professional's approach of buying high and selling higher, which I'll teach you to do consistently. Being in touch with all the financial and economic news won't put your investments in the plus column either. In a world of computers and instant communications, the financial markets respond to the latest news long before you read or hear about it in the press. In addition, the market sells on future rather than current earnings. In order to be successful, you have to learn to use the many clues the market action provides. This book will show you how to uncover those clues and turn them into profits. Finally, relying on the advice of Wall Street wunderkinds, the brokers and analysts, won't get you very far. The overwhelming evidence is that their advice is inferior to the advice you will get from a set of darts thrown at a stock page. And believe me, a set of darts is far less expensive. Too many of these people spend their time talking with other brokers and analysts. They go to luncheons where executives of the Fortune 500 companies treat them to chicken Kiev and information about current company performance. You don't have to go to more than a few of these functions to realize that both the chicken and the information being served have been on the warming tables for a long time. The real market professionals, the specialists on the floors of the exchanges, don't adhere to any of these misguided approaches. They base their decisions on market actions, not the news. And while others follow the clichés into the loss column, the real market pros are making plenty of money. Mr. and Mrs. Average Investor declare that they are unlucky in the stock market, but this is nonsense. It isn't a matter of luck at all. They are playing the game by the wrong set of rules, and until they learn what the winning rules are, they will continue to have poor results. What they need in order to get on the winning road is a consistent method of properly timing the market and controlling their two market enemies, greed and fear. That's what this book is all about, winning. After having made plenty of mistakes, I've learned how to decipher the very obvious clues that the market gives us and then tactically respond to a given situation. I'm going to teach you a new set of stock market rules that will make the market much less stressful and far more profitable for you. These rules won't have you poring over balance sheets or listening to some company spokesman drone on about his firm's progress toward higher returns on shareholders' equity. These rules will require that you do two things: control your own greed and fear, and find and decipher the obvious clues that the market tosses your way. That's what I'll teach you in this book, and what you'll learn will make you a winning investor. Best of all, once you get the hang of it, you only have to spend about an hour every week implementing this winning approach. Over the past 25 years, I've learned what works and what doesn't, and I've refined this knowledge and experience into an approach for consistently staying on the winning side of the market. This method has enabled the professional tape reader to forecast every bull and bear market during the past 15 years. You can use these techniques in any market, be it stocks, mutual funds, options, stock index futures, or commodities. While each of these markets will be covered in the following pages, the major emphasis will be on the stock market. Before going further, I want to stress that this isn't a get-rich-quick book. Dozens of those books cross my desk each year, and most literally aren't worth the paper they are printed on. Many are so simplistic that they're practically worthless. Others are so pedantic and theoretical that all you get out of them is a headache. Even worse, others promise you the sky and the moon. If you want a book that is going to turn $10,000 into $1 million by 4 p.m. next Tuesday, then stop reading right now. But if you are serious and want to learn how to consistently profit year in and year out, in both bull and bear markets, and want to amass a tidy sum over the next several years, then this book is for you. Understand something else. We are a team. The more you put into learning my methods, the more chips you'll take from the table. It's no different than taking a tennis lesson from a pro. The 1-hour lesson is just the start of the learning experience. The second and equally important step is to practice what you've learned. For my part, I will make the learning very easy. I've done it for years, writing the professional tape reader and conducting teaching seminars all over the country. So don't worry if you've never looked at a chart or plotted an indicator before. You will quickly understand and learn how to use my methods if you do your fair share. Unlike some books on technical analysis, which are so esoteric that only the author and a few academic types can understand them, this book will deal with only those factors that I rate a 10 in importance for making money, while leaving the 1s and 2s alone. In addition, this text will flow logically from chapter to chapter and will slowly develop your profit-making ability. To help you gauge even further just how quickly you are grasping the method, several of the chapters will end with a short quiz. If you find that a given chapter isn't 100% clear, quickly scan it again until you master the material before moving on. My philosophy of investing. In the following pages, you are going to learn exactly how I go about analyzing and beating the market. While it certainly isn't easy, it's not nearly as difficult as most investors and traders make it. Lesson number 1 is consistency. For over 25 years, I have been consistent in my approach and discipline. This is so very important. Don't be a fundamentalist one week and a technician the next. And don't follow indicator A 1 month and switch to indicator B the next. Find a good method, be disciplined, and stick with it. If it doesn't regularly beat the market, then get a new method. But be absolutely disciplined and don't ever abandon a successful method because you think this time things are different. Lesson number 2 is to learn what most investors never do: that you cannot consistently make money in the market by reading today's fundamentals in the newspaper and acting on that information. That is a prescription for disaster. It's a little draught of poison taken by most novice investors. You must learn that the market is a discounting mechanism, and that stocks sell on future and not current fundamentals. I therefore use a technical approach that deciphers the market's interpretation of all of the currently known news as well as future expectations. Don't be thrown off by the fancy name. All that technical analysis really consists of is the study of price and volume relationships to gain an insight into future trends. In this book, I am going to teach you a new set of rules and a new market language that will make the market far more predictable, profitable, and enjoyable. Unfortunately, most traders and investors think that technical analysis is akin to black magic or astrology. And the way some technicians operate, that's not too far off the mark. Technical analysis is more an art than a science. And just as everyone who picks up a paintbrush is not a Picasso, everyone who opens a chart book is not a John Maggi. I'm going to teach you this approach. It will be a new set of rules for you. Properly used, however, this approach to the market will make winning much easier for you. Can you be perfect? Of course not. No quarterback in the National Football League can complete every pass either. You don't have to be right all of the time. By consistently following my methods, you will be right a very high percentage of the time. One secret that most professionals know is that you can rack up a fortune in the market by being right less than 50% of the time, as long as you let your profits run and cut your losses quickly. A future chapter will show you how to correctly deal with a losing situation, which is one of the most profit-enhancing secrets that you'll ever learn. Why the technical approach? Now let's get to specifics. First of all, put aside all of your preconceived notions about the market and get ready to start anew. Just as when you embark on a weight loss program that requires you to first purge your system, here, too, the starting point is to put aside all of your prior beliefs and start over, slowly building step by step. If you are a confirmed fundamentals addict, don't worry. You will experience no withdrawal symptoms, not even hallucinations. After you've mastered this new approach, you'll be able to synthesize the two methods and better time your fundamental buys and sells. On the other hand, if you really become polished in this technical method, then the chances are very good that you'll do as I do and ignore the headlines while paying strict attention to the message of the tape. It's no coincidence that the motto at the top of each issue of PTR is "The tape tells all." That's more than a cute slogan, it's a market philosophy that works. What it simply means is that all of the relevant information about a company's earnings, new products, management, and so forth, the fundamentals that is currently known and cared about, is already incorporated in the price of its stock. It isn't that I don't care about an important piece of fundamental news, such as a pending takeover offer. Rather, I learned long ago that you and I aren't going to find out about that juicy news before it hits the broad tape, and by then, it's too late. Sure, we'll hear rumors, but for every 100 that you'll hear, no more than 1 or 2 really pan out. That is not a way to rack up a winning percentage in the market. So accept the fact that unless you're willing to break the laws on insider trading, you aren't going to find out about that important piece of news ahead of time. And once you read the news in the paper, it's too late to act on it profitably. The remarkable thing is that, when you learn how to properly interpret what's taking place on the tape, and on your chart, you'll often be buying or selling with the insiders without even knowing it. You don't have to be Sherlock Holmes to know that something is up in stock XYZ if it has traded an average of 20,000 to 30,000 shares each week over the past several months while quietly moving back and forth in an 8 to 10 trading range. And then, suddenly, it breaks out above its ceiling, or what we technicians call resistance on huge volumes, say 250,000 to 300,000 shares for the week. Now look at the charts of Piedmont Aviation and Spectradyne charts 1-1 and 1-2. While you don't yet have the trained eye that you'll possess 100 pages from now, even the uninitiated can see some very unusual and exciting action starting to take place several months before the Piedmont announcement was made in early 1987, and before the mid-1987 Spectradyne announcement. While I wasn't privy to inside information, I listened to the message of the tape and recommended both of these issues in PTR before the takeover news and the huge gains took place. See arrow for points in charts 1-1 and 1-2. Obviously, considerable insider buying was taking place. When you've finished reading this book, turn back to this page and you'll see even more clearly why you would never in a million years have considered selling these stocks as many thousands of investors did day after day, while they moved higher. Even more importantly, you'll see why you should have called your broker with buy orders. Furthermore, it doesn't have to be fundamental news as sensational as a takeover to see the merits of listening to the tape. Look at charts 1-3 and 1-4 of Harrah's and TS Industries. In hindsight, Harrah's was a great buy in 1978 and TS Industries an even better purchase in 1986. But here are two interesting facts that should make you more open-minded to the technical approach. First, they were both recommended as buys in the professional tape reader, see arrows. Second, they both had less than inspiring fundamentals when they were recommended and were rocketing higher. Harrah's trailing 12 months earnings had just dropped down to $2.38 from $2.41. Then, over the next 6 months while the stock more than doubled, the earnings dropped even further to $2.16. TS Industries' performance was even more spectacular in conjunction with even worse fundamentals. When the stock was recommended early in 1986, the latest 12 months trailing earnings were 37 cents fair, but not exciting. Then, 15 months later when the stock was 200% higher, earnings were an even worse 9 cents per share. Crazy? Not at all. Once you learn how the market really works, rather than how the ivory tower textbooks say it's supposed to function, you'll see that such action is commonplace. And rather than becoming confused as you master my technique, you will profit by such disparities. When we examine the overall market, the same pattern shows up quite clearly on a grander scale. In late 1974, the Dow Jones Industrial Average had crashed from above 1,050 down to 570. The gloom and doom was so thick you could just about touch it. The news headlines were absolutely ghastly. Chart 1-5. One leading financial newspaper ran a lead story titled World Depression, and that was the good news. To top things off, one leading news weekly featured a picture of a bear knocking down the pillars of Wall Street. Fear was widespread that the market was going to crash further, possibly to 250 to 300. Amidst all of this pessimism and fear, our technical indicators roared by, and a new bull market was born that soon took the Dow back above 1,000. Now do you get the idea? There's a reason why savvy market professionals know that you buy on the bad news and sell on the good news. Stocks form bottoms when the current news is terrible and top out when the public is ecstatic about glowing earnings reports, stock splits, and so on. It's therefore not surprising that typical traders and investors buy near the top, when the news is great, and then dump their stock for big losses near the low, when the media are reporting ghastly news. It's not luck, good or bad, that causes consistent losses for the public and consistent profits for the real professionals, but the rules by which the two groups are playing. It's really no different from a professional poker player who understands the odds and refuses to pull to an inside straight, while the amateur lets his hunches and feelings lead him into losses. Therefore, your philosophy should be simple. 1. Never buy or sell a stock without checking the chart. 2. Never buy a stock when good news comes out, especially if the chart shows a significant advance prior to the news release. 3. Never buy a stock because it appears cheap after getting smashed. When it sells off further, you'll find out that cheap can become far cheaper. 4. Never buy a stock in a downtrend on the chart. I'll soon show you specifically how to define a downtrend. 5. Never hold a stock that is in a downtrend no matter how low the price-earnings ratio. Many weeks later and several points lower, you'll find out why the stock was going down. 6. Always be consistent. If you find that you're sometimes buying, sometimes selling in practically identical situations, then there is something terribly wrong with your discipline. So understand that chart reading and technical analysis is not some arcane science. It's not black magic or astrology. Very simply, it is learning to read the cardiograms of the market's health. Your physician runs X-rays, blood tests, and X on you before making a diagnosis. The competent technical analyst does the same to the market. Neither one is a witch doctor, though I have some reservations about certain MDs I've known. So let's move onward as I turn you into a stock market intern. Let's all speak the same language. Before charting your way to a profitable future, there are a few basic terms that you must become familiar with. Chart 1-6 will help you better understand what they mean. Even if you aren't technically oriented, you've probably heard and seen many of these terms, but you might be a little fuzzy about their exact meaning. No problem. A quick review will do the trick. Even if you're a seasoned technician, check how I define each term so we'll all be on the same wavelength. This is very important as these are the building blocks of my technical method, and they will be used repeatedly throughout this book. So take a minute or two to go over the definitions, and be sure you are clear about the meaning of each. If you pay your dues here in Chapter 1, the book will be easy to understand and very profitable for you. If you aren't 100% sure about a term, refer back to this section later on. I'm not going to introduce these technical terms in strict alphabetical order, since some become easier to grasp after you already understand a given definition. The first thing to do is to study Chart 1-6 of Stock XYZ for a moment. Just look it over and try to initially grasp whatever makes sense to you. Then, on the next round, read one definition at a time, reflect on it, and study only that term on the chart in conjunction with the definition. Don't overwhelm yourself and try to remember all of the meanings at once. That's not really necessary. For many of you, it's a new language that you're learning, but if you go through this section slowly, it will start to make sense. After a few chapters, you'll feel like an old-time technician. Let's start with support. The area where a stock that has been declining is likely to stabilize and then bounce off and move higher, at least temporarily. It's like a floor. Be aware, however, that you can't become fanatical, as too many technicians often do when talking about support as being at a certain point. It's really an area or zone. In Chart 1-6, support is first in the 26 to 26.50 zone. The first low was at 26, the next at 26.50. The third decline halted at 26.25, while the next sell-off held at 26. Be aware that a break below the absolute bottom of the support zone, in this case 26, has very negative implications for the price of the stock. The more times a given support level is tested, and the longer the time period during which the testing takes place, the more important the negative signal that is flashed if that zone is eventually violated. Also be aware that once a major decline or advance gets underway, new support levels will form along the way. In the case of XYZ, new support formed in the 8 to 8.50 area, see Chart 1-6. Resistance, also supply. The two terms are interchangeable. The zone where a rallying stock is likely to run into trouble at least temporarily, and then be turned back. The more times the given resistance area is tested, and again the longer the time period involved, the more important the bullish signal that is given if the resistance zone is eventually overcome. In our example on the chart, there is resistance first near the 30 level. After the major decline, the next valid resistance zone becomes 11.50 to 12. The first rally failed at 12, the second at 11.50, and the next at 11.75 before XYZ broke out above the top of the range. Always remember that a move above the top of the resistance range is a very bullish indication for the price of the stock. Once again, you must realize that when a major move gets going, new resistance or supply levels will form along the way. In the case of XYZ, there was first resistance in the 29.50 to 30 zone, later on in the 11.50 to 12 area. Trading range. The neutral zone in the ongoing battle between buyers and sellers. When a stock is in an uptrend, the buying army is obviously stronger than the selling side and rising prices result. A downtrend is the flip side of the coin, where the selling side is much more powerful than the buyers. But in a trading range, the two sides are equal in strength, and the battle rages between the support zone, in this case 8 to 8.50, and the resistance area, 11.50 to 12 on the accompanying chart. Note that there is also a second trading range on the chart, in the 26 to 30 area. Moving average MA. A very important technical tool that helps alert you to both shorter and longer-term moves. All that a moving average really does is smooth out the major trends, so the wild day-to-day gyrations, which the new buying and selling programs have made even wilder, do not throw off your market perspective. Over the years, I've found that a 30-week moving average MA is the best one for long-term investors, while the 10-week MA is best for traders to use. A 30-week MA is simply the closing price for this Friday night added to the prior 29 Friday weekly closings. Divide that figure by 30, and the answer is what's plotted on this week's chart. Stocks trading beneath their 30-week MAs should never be considered for purchase, especially if the MA is declining. Stocks trading above their 30-week MAs should never be considered for short selling, especially if the MA is rising. For a long-term investor, the ideal time to buy a stock is when it breaks out above resistance and also moves above its 30-week MA, which must no longer be declining. For a trader who wants action, the ideal time to buy a stock is when it's already above its 30-week MA, when the MA is rising. The trader's ideal entry point is after a stock consolidates in a new trading range and pulls back close to the moving average, then breaks out again above resistance. Breakout. When the price of a stock moves above the top of its resistance zone, 12, on the XYZ chart. In this case, the breakout would occur at 12.125 once the top of the resistance zone is cleared. Just as there are grades of eggs, there are different qualities of breakouts. Two hints to always remember are: 1. The longer the time spent below the resistance, the more significant is the eventual breakout, and 2. The greater the expansion of volume on the breakout, the more bullish the implications. Don't worry, we'll go into much greater detail in the coming chapters. For now, remembering these two simple rules will add greatly to your profits. Breakdown. The mirror image of breakout, as the price of a stock moves below the bottom of the support zone, 26 in this example on the XYZ chart. In this case, the breakdown would occur at 25.875, as the bottom of the support zone was pierced. Unlike a breakdown doesn't need very heavy volume to be valid. Stocks can literally fall of their own weight, but there should be some increase in volume. Pullback. After a stock breaks out of its trading range and advances, there is usually at least one profit-taking correction that brings the price of the stock back close to the initial breakout point, in this case 12.125. This is an ideal second chance to do further buying, especially if the pullback occurs on sharply decreased volume. On the other hand, after a stock breaks down below support and declines, there is usually at least one pullback back up toward the breakdown level, in this case 25.875. If this occurs on very light volume, it is an ideal entry point to sell the stock short. Trendline. If you take a ruler and connect any two lows on a given chart, you've drawn a trend line. However, there is a big difference between a trend line and a significant trend line. A significant trend line will be touched at least 3 times. Chart 1.7, Skyline, illustrates a significant trend line. It was hit 4 times before it broke on the 5th testing of the line. These are the lines that should set off sirens when they are violated, because the break signal major changes in the trend's direction. A break below an advancing trend line is negative, while a break above a declining trend line is bullish. Note that once Skyline broke below its uptrend line, it literally crashed. It's also important to realize that the greater the slope of a given trend line, the less meaningful its break is on the downside. If you have a very steep advancing trend line, chart 1.8, a break below that trend line may merely mean that a stock, or a market average, is now going to move up at a slower rate of advance. because its prior rate was simply not sustainable. The closer a trend line is to being horizontal chart 1-9, the more negative the implications are when it is broken on the downside. Conversely, the steeper the angle of descent of a declining trend line chart 1-10, the less bullish its implications are when it's overcome. All it may mean, especially if the stock is below its long-term MA, is that the stock is now going to decline at a slower rate of descent. However, the closer to horizontal the trend line is when it's broken on the upside chart 111, the more bullish the implications are. The most bullish signals are given when a very important trend line is broken on the upside, and within a matter of days, the long-term MA is also overcome on the upside. Conversely, the most negative implications are given when a significant trend line is broken on the downside, and within a matter of days, the long-term MA is also violated on the downside. Uptrend. Simply a series of higher peaks and higher lows on a given stock or market average that lasts for a minimum of several weeks to a maximum of years, see chart 1-6. Downtrend. A series of lower peaks and lower bottoms on a given stock or market average that once again lasts from several weeks to years, see chart 1-6. Terms such as trader, investor, short-term, and long-term are relatively subjective. It's important for you to know what I mean when I use them, since one person's investing definition is another person's trading time frame. Trader. When I address traders in this book, I am not talking about people who buy in the morning and sell in the afternoon. My definition of a trader is someone who wants to catch each significant 2 to 4 month move. This is what I consider intelligent trading. Buying on Monday and selling on Tuesday is smart only if you want to make your broker rich. Investor. My investing time frame is up to 12 months. That doesn't mean you can't end up holding a stock longer, but I don't feel it's relevant to talk about the market or stocks in terms of 3, 4, or 5 years. There are too many variables and too many cycles that can come into play over so long a time frame. Short term. By my definition, short-term moves are those cycles that last from 1 to about 6 weeks. Intermediate term. Those cycles which run from 6 weeks to approximately 4 months. Long term. My definition of long term is 4 to 12 months. The major trends are long term and always the most important patterns to be aware of. If you are in harmony with a long-term trend, it will often bail you out of a short-term timing error. Relative strength. How a given stock or group acts in relation to the overall market. For instance, if stock XYZ rallies 10% while the market moves ahead 20%, that's poor relative strength even though the stock has advanced. On the other hand, if stock XYZ declines 10% while the market averages decline 20%, that's favorable relative strength even though the stock has moved lower. The formula for measuring relative strength is simply the price of a stock or group average divided by the price of a market average. Short selling. This is the most misunderstood and underutilized of techniques. The pros use it, but 9 out of 10 individual investors have never even tried it. Short selling is placing a sell order for shares you do not currently own in the expectation that the share price will drop in the future. If you sell short XYZ at 20, you simply borrow the shares from your broker for delivery to the buyer. If XYZ drops to 10, as you'd expected, you then buy XYZ shares in the market to replace those you owe your broker. In the process, you make $10 per share. So who says you cannot make money in bear markets? I'll devote an entire section to short selling at the right time. Now that you've read each of the definitions and have at least a working knowledge, go back to chart 1-6 and study it again. It should now make much more sense to you. If in the coming chapters you forget what a term means or aren't 100% sure, just reread that term in this section. The next exciting concept to move on to is the chart itself. But before you do that, here's a quick quiz so you can test yourself on how well you understand the basic building blocks. The answers follow the quiz. Charts, they come in all forms. While there are many different types of charts available daily, weekly, monthly, there are 2 basic kinds that we should be familiar with. While I'm going to expose you to all of them, I'll show you which are easiest and most effective to use for traders and which for investors. First, There is the line or bar chart, which depicts volume along with the high, low, and closing price for a given time period. The second chart style is the point and figure approach. See Chart 112 of Marion Labs, which records only price changes while ignoring time and volume. Therefore, if a given stock swings wildly in one day on a point and figure chart, there would be several entries for that day. Then, if the stock trades basically unchanged close to the same price for the next several days, there would be no further entries made because there were no price changes to record. Point and figure, P and F charts are basically compact summaries of the action. This P and F chart of Marion Labs shows 20 years of history. They're very useful for spotting important formations, identifying areas of support where a stock will stop declining, and resistance zones where a given advance will run into trouble. While I use them in conjunction with all of my other charts when analyzing a stock, they should never be used alone since there is no volume signal and no MA. In addition, they are much more difficult to master. So in this book, I am going to stick strictly with bar charts. When properly used, bar charts can help you reap some very substantial profits. Now let's return to bar chart analysis. It really doesn't matter what time period we are dealing with, but for this illustration, chart 113, let's assume we are talking about 1 day's trading, a daily chart. If the high for this day is 18 and the low is 16.50, all you do is place a dot at the high of the day, 18, and at the low, 16.50, and draw a straight line. If XYZ closed that day at 17.50, you put a horizontal tick line on the days trading at 17.50. As for the volume, there is a separate scale at the bottom of the chart on the same day's axis. If the volume for the day was 25,000 shares, you simply put a dot at the 25,000 share level and then bring that line down to the 0 line on the volume scale. The next day the high was 18, the low was 17, and the close was 17. One line over to the right on the time scale, you again plot the high of 18, the low 17, and the close 17. The volume for this second day, we'll say, was 20,000 shares. That's all there is to the plotting. It's not mystical and certainly not difficult once you do it a few times. The only difference on a weekly chart is that you plot the high, low, and close for the entire week, Monday trading through Friday. You also plot the volume for the entire week. On a very long-term chart, you can do the same thing for the entire month, high, low, close, and volume for the whole month. Charts 114, 115, and 116 show examples of each chart. All three charts have a function. The daily chart 114 is definitely best for shorter-term trading where near-term definition is important. The monthly chart 116 is on the other side of the spectrum and is a fine tool for very long-term investors who are looking for trends of several years. In between these two extremes are the Mansfield weekly charts 115, which are a good compromise of the other two. There is enough definition to trade, although very short-term traders should use daily charts, but they are especially valuable in showing the really important moves that matter to intermediate-term traders, several months, and investors. While we will refer to all of these charts throughout this book, we will draw heaviest on the weekly Mansfield charts, as they are the best all-around charts for investors, especially since they show more than 2 years of history at a time. Nevertheless, be aware that all three are excellent chart services and all serve their purpose. Reading the Mansfield chart. Now let's get to the nitty-gritty and study a weekly Mansfield chart, chart 117. If you've never looked at one before, don't be overwhelmed. I promise that in 5 minutes it will all make sense to you. If, however, you're an old hand at technical analysis, you can quickly skim the next page or two while everyone gets on an equal technical footing. I won't bother you with all the features, many of which are fundamental, that are on the chart. Many are confusing and not necessary. Instead, we'll stick to what's really important and profit-producing on the chart. 1. The first thing to look at is each high, low, close spike. The stock's price is the most important component of the chart because, over time, it forms the pattern that will give us clues and subtle insights into the next major move. 2. The second factor is the volume plot for the week. It's a favorable signal when volume expands as a stock rises and decreases as a stock declines. As we said earlier, and will stress many more times throughout this book, it's very important that volume is large and expanding on a breakout. Heavy volume signals urgent and powerful buying that will propel the stock much higher. 3. The third important detail on this chart is the 30-week MA. Mansfield charts do not give a simple 30-week MA where all 30 weeks count equally. Instead, they use a weighted 30-week MA whereby the most recent action counts far more than the old input. This makes the MA more sensitive to current activity and helps it reverse direction faster. The drawback to their weighted average is that it leads to a few more whipsaws. Nevertheless, since it is such a long-term MA, the signals are still quite good. Remember, never buy a stock, no matter how cheap it appears based on fundamentals or a recent sharp decline, if it is trading below its declining 30-week MA. The price performance is giving you a clear signal that there's a worm in the apple. Don't even think of buying it. Conversely, never sell short any stock that is above its rising 30-week MA no matter how high the price-earnings ratio is. 4. The fourth item to be aware of is the long-range background. These are the yearly high-low figures located in the lower left-hand corner of the Mansfield chart. The value of the long-range background chart is that it helps you put current price activity into historical context. When an upside breakout moved Goodyear Tire to a new high for 1986, see Chart 118. A quick glance at the background chart would tell you that it was also a new high for the past several years. That is an especially favorable situation, as it shows that there is no further resistance overhanging the stock. It is in virgin territory, and there are no sellers who are looking to get out even. In the absence of the sellers, the stock can move still higher. That's just what Goodyear Tire did in late 1986 through early 1987. It's no coincidence that it rallied more in the few months after it broke above the 37 high than in the several years prior to that break into virgin territory. On the other hand, a breakdown on the chart that drops a stock to a new yearly low is a dangerous pattern. And when you look at the long-range background and see that a stock has also broken to a new low for the past several years, you should recognize this as an especially bearish and dangerous situation, which should most definitely be avoided on the long side. Campbell Resources, Chart 119, provides us with a textbook example of what happens when a stock breaks down and there is no long-term support beneath it. Campbell broke below 7.50 and eventually hit bottom at 75 cents before reversing. 5. The final important part of the chart to be aware of is the relative strength line. As long as this line is in a downtrend, don't consider buying the stock even if it breaks out on the high-low close price chart. Poor relative strength shows that it is still an inferior performer compared to the overall stock market. On the other hand, if the relative strength line is in an uptrend, don't consider selling the stock short even if it breaks down on the price chart. Another important use for this relative strength line is to watch for those situations where it moves from negative territory, below the zero line, to positive territory. That is another favorable signal. In cases such as Amdahl, Chart 120, and Newmont Mining, Chart 121, both PTR recommendations in the summer of 1986, see arrows, where an upside breakout also is accompanied by a move by the relative strength line into positive territory. The probabilities of buying a big winner are increased substantially. Conversely, when a breakdown on the price chart goes hand in hand with a move into negative territory, below the zero line, by the relative strength line, see charts 122 and 123, it's a case of look out below. Be sure to treat these as bearish situations no matter how cheap they may appear based on fundamentals. Both Ocean Drilling and Reading and Bates show you what can happen. Even though they had fallen substantially before their relative strength line turned negative, once their relative strength graphs dropped into negative territory, there was far more decline ahead of them. That's it. That's all you need to know to be able to profitably read a chart. There is a lot more to be learned about chart analysis. Many excellent volumes have been written on the subject, but you've just learned the lessons of chart reading that have the greatest payoff. With these simple but important tools, you are now ready to start charting your way to a much more profitable future. Chapter 2. One glance is worth 1,000 earnings forecasts. The title of this chapter is something I really believe in. All you have to do is look at a stock like General Motors, which had improving earnings in 1981, as it dropped from 58 to 34, or a stock like Greenwich Pharmaceuticals, which moved from 3 to 19 in the 1986 to 1987 period while it registered deficits. So remember, it is really true that the tape tells all, and our job is to learn how to listen properly. You are now ready to start working on your degree in technical analysis and to start learning how to apply my methods so the market can become less mystical and more profitable for you. Look at this stage chart, Chart 2.1. If ever the cliché that a picture is worth 1,000 words was true, this is a perfect example of it, in living color. Study Chart 2.1 for a minute. This is how you are going to start analyzing stocks and the market from now on. Once you grasp this profitable technique, the market game for stocks, options, mutual funds, commodities, or you name it will become much easier and more profitable. You'll be able to flip through any chart book and immediately spot those few stocks worthy of further study and possible action, while eliminating the scores of issues that aren't worth another moment of consideration no matter how exciting the newspaper headlines. Just remember this basic fact. Any stock has to be in one of 4 market stages, and the trick is to be able to identify each one. The 4 stages of a major cycle, as illustrated in Chart 2.1 are 1. The basing area, 2. The advancing stage, 3. The top area, and 4. The declining stage. Stage 1. The basing area. After stock XYZ has been declining for several months, it eventually will lose downside momentum and start to trend sideways. What's actually taking place is that buyers and sellers are starting to move into equilibrium, whereas previously the sellers were far stronger, which is why the stock had plummeted. Volume will usually lessen, dry up, as a base forms, but often volume will start to expand late in stage 1, even though prices remain little changed. This is an indication that dumping of the stock by disgruntled owners is no longer driving down the price. The buyers who are moving in to take the stock off their hands are not demanding any significant price concession. This is a favorable indication. Here's how it appears on the chart. Initially, the 30-week MA loses its downside slope and starts to flatten out. In addition, intermittent rallies and declines will toss the stock above and below the MA. During this stage, there will usually be several swings between support at the bottom of the trading range and resistance at the top of the range. This basing action can go on for months or, in some cases, years. This is the point where many market players get itchy to move in and catch the bottom price, but it doesn't do much good to buy yet. Even if you catch the exact low, your money could be tied up for a long time with little movement, and time is money. Even worse, premature investors often get impatient and end up selling after months of frustrating sideways action right before the big move starts. Now study Chart 2.2, Bethlehem Steel, which is in Stage 1 shaded area. Note that after dropping sharply from 22 to 4.625, it finally managed to rally up to and then above the MA. The next decline took it slightly back below the MA, and then the next rally on increasing volume saw BS break above its horizontal trend line as the MA started edging higher. Once BS moved above 9.375, it was now ready for a Stage 2 advance, and it quickly soared to 17.25 over the next several weeks. Stage 2, advancing phase. The ideal time to buy is when a stock is finally swinging out of its base into this more dynamic stage. Such a breakout above the top of the resistance zone and the 30-week MA should occur on impressive volume. This is the start of the advancing Stage 2 uptrend phase. However, before the really dynamic part of the advance gets rolling, be aware that there is usually an initial rally followed by at least one pullback. That dip brings the stock back close to the breakout point, which is a good second chance to do low-risk buying. Don't become a fanatic about saving a few cents per share. If the breakout occurs at 12.125, for example, the pullback may turn out to be 12.375 or 12.625, but will come close. The less it pulls back, the more strength it actually is showing. Interestingly enough, at the breakout point, which is the perfect time to buy, the reported fundamentals will often be negative, and unless your stockbroker is technically oriented, he may try to talk you out of buying the stock. In stage 2, the 30-week MA usually starts turning up shortly after the breakout. The situation becomes a buyer's dream as each successive rally peak is higher than the last. In addition, the lows on corrections are also progressively higher. This is important. Don't expect the stock to be a one-way street no matter how bullish and powerful the pattern is. Chart 2.3 of International Paper illustrates what I am talking about. Once it moved into stage 2, shaded area, in early 1986, all downside corrections were contained above the rising 30-week MA, and each rally took IP to another new high. The market is always tricky, and there is a reason why the overwhelming majority of investors lose money over the years in the market. The stock market, or any market for that matter, will do whatever is necessary to keep the majority from making money while amply rewarding the astute professional minority. So expect 2 steps forward and 1 sharp step back. As long as all of these wild swings and shakeouts take place above the stock's rising 30-week MA, don't worry. Everything is proceeding according to Hoyle and is on schedule for a big profit. After several months of bullish bliss, as the fundamentals start to improve and more investors belatedly jump on the bullish bandwagon, the stock will eventually start to sag closer and closer to its MA. The angle of ascent of the MA will slow down considerably. At this point, the stock is a hold. Although it is still in stage 2, this stock is now trading far above its support level and MA and is being discovered by the investment community. It is overextended and most definitely no longer a buy. This is the point where buying puts you at considerable risk. From an investing point of view, we'll deal with trading in a later chapter. The right time to buy the stock was either on the initial breakout or on the later pullback toward the breakout level. 12.125 on our XYZ chart, 1.6 on page 11. At that time, when the stock was still close to its base, the downside risk was quite low and the upside potential considerable. The reward/risk ratio was totally in your favor. Now, however, that obviously is not the case. In addition, the later we get into stage 2, the more erratic the price swings become as early buyers panic on sell-offs because they don't want to lose their excellent profits. The Johnny-come-latelys buy in on each sell-off as they want to get a bargain in their newly discovered hot stock. At this point, the stock is the subject of rumors and glowing press reports. It's also the point where emotions are having a big impact on the decisions of both buyers and sellers. I can't stress how many times I've seen portfolios filled with big losses because the entry point for the given stock was poor. Be disciplined. If you are a long-term investor, buy only at the proper entry point early in stage 2. In the case of XYZ, near 12.125. If you miss buying a stock, don't get panicky and chase it and just end up paying any old price. Be consistent. Either buy it right or don't buy it at all. Obviously, a little common sense is needed. If you miss it at 12.125, buying at 12.875 is no big deal, but paying 25 or 26 sure is. If you've missed a good stock, don't fret about it. With thousands of listed and over-the-counter stocks to pick from, there will always be good stocks at great prices. It's similar to hailing a taxi. If you miss the first one, another one will soon come along. Stage 3, the top area. Eventually, all good things come to an end. In the stock market, this takes the form of a stage 3 top as the upward advance loses momentum and starts to trend sideways. What's going on beneath the surface is that buyers and sellers are once again about equal in strength. In stage 2, the buyers were far stronger and overwhelmed the sellers. Now that the advance is ending, the stock is in equilibrium, and the mirror image of a stage 1 base starts to take shape. Volume is usually heavy in stage 3, and the moves are sharp and choppy. If you've ever heard the expression that a stock is churning, moving sideways on heavy volume. This stage is an outstanding example of it. The heavy volume on the part of buyers who are excited by the improving fundamentals or story is met in equal measure by aggressive selling by the people who bought at considerably lower prices and are heading for the exits. Here is how all of this takes shape on the chart. First, the 30-week MA loses its upward slope and starts to flatten out. Whereas Stage 2 price declines always held at or above the MA, the stock will now tiptoe below and above the MA on declines and rallies. Once a Stage 3 top starts to form, traders should get the heck out with their profits. Investors, however, have more leeway. Once this stage is reached, I suggest that investors take profits on only half of their position. There is always the chance that the stock will break out on the upside again, beginning yet another Stage 2 up leg. If you still hold half of your original position, you'll then be able to benefit from the upward movement of this new Stage 2. But it's imperative that you protect your profits on the remaining half position with a protective sell stop set right beneath the bottom of the new support level, in this case, 25.875, see Chart 16, page .11. For now, just accept this as good market tactics. In a later chapter, we will show you how to properly set your stops, which not one investor in 100 knows how to do, and which is one of the real secrets of stock market success. Chart 24 of ICH Corporation is a perfect illustration of Stage 3 shaded area. Note how the moving average stopped rising, and how ICH broke below and then temporarily back above it. Even though the price/earnings ratio was only 10 at that time, and earnings were still on the upswing, this stock was clearly in trouble. Once it broke below 24, the Stage 3 top was complete, and Stage 4 was ready to unfold. Now that ICH was in Stage 4, it dropped by more than 50% over the next 6 months, in the midst of one of the great bull markets in history. Be very careful to keep your emotions in check in Stage 3, because the stories about the stock will usually be exciting and the news glowing good earnings, stock splits, and so on. As always, have faith in the chart since, unlike you and I, it is not emotional. By learning the consistent discipline of following the market's message on the chart, we too can learn to be cool, calm, and calculating while others get consistently whipsawed by the greed-fear syndrome. So remember, no matter how powerful the fundamentals, no matter how convincing the story, you are never going to buy a stock in this stage because the reward and risk ratio is strongly stacked against you. Stage 4, the declining phase. This is a period when the factors that maintained a stock's price during the topping phase give way to the fatigue and pressures of fearful sellers. It shows up on the chart in the following manner. After moving back and forth in a neutral trading range, a stock eventually breaks below the bottom of its support zone. Our XYZ chart, 16, shows a support zone of 26 to 26.50, resistance near 30, and a basically flat MA. Unlike an upside breakout, which needs a significant increase in volume to be considered trustworthy, a downside break into Stage 4 doesn't necessarily need such a huge increase in volume to be considered valid. A volume increase on a breakdown followed by a volume decrease on a pullback to the breakdown point does signal a very dangerous situation. Yet I've seen many cases where a stock moved into Stage 4 on relatively light volume and dropped substantially in the months ahead. Therefore, while a volume increase on the breakdown is even more bearish, don't ever let yourself get lulled into a false sense of security because the volume isn't heavy. One way or another, you should get out of the stock. If your broker is a fundamentalist, he may try to dissuade you because the earnings and other fundamentals may be in pretty good shape. And the conventional thinking as Stage 4 starts to unfold is usually that the stock is just undergoing a correction. This is nonsense. Once the stock breaks into Stage 4, the upside potential is very small. The old 26 to 26.50 support zone of XYZ becomes the new ceiling or resistance area once the breakdown occurs, while the downside risk is considerable. At this moment, stop and reflect for a second and then make a pledge to yourself. Take the oath that you are never going to buy another stock in Stage 4. Also promise yourself that you will never hold onto any of your stocks once they move into stage 4. I'll show you in the chapter on stops how to make this last promise easier on yourself, so that it will be done automatically without your doubts and second and third guesses ever coming into the process. It will be mechanical and disciplined. Don't get caught up in the macho game of riding out a decline. Hanging tough in stage 4 is a masochistic and costly game. There is absolutely nothing ennobling or character building about watching your hard-earned money go down the drain. All that you have to do to learn this incredibly important market lesson is to play the Kenny Rogers record, The Gambler. I'm not kidding. There's more solid market tactics in that short song than in all the fundamental cliches that bounce off the buildings on Broad and Wall Streets. Think about these words of wisdom. You've got to know when to hold them, know when to fold them, know when to walk away, know when to run. Whether you are playing poker or the stock market game, it's crucial to learn to play the odds and to use professional tactics. If you change nothing else in your market operations after reading this book except to never buy or hold stage 4 stocks, I can absolutely promise that you will improve your batting average so much over the next year that when you see your next year's income tax return, you'll think your accountant made an error. Don't get me wrong. There's much more you have to learn to really become a big winner, but this one tactic is so important that I want to stress it. Market analyst Kenny Rogers goes on to tell us that every gambler knows that the secret to surviving is knowing what to throw away, knowing what to keep, because every hand's a winner, every hand's a loser. This point is also true. I've seen many portfolios over the years that had more winners than losers, yet they end up with major losses. The amateur investor creates a nightmare as he sells the winners too quickly with small profits, while holding the losers that turn into stage 4 disasters. The more sophisticated players, however, end up with super profits because they ride the stage 2 winners all the way up while quickly getting out of their problem stocks. So it really is a matter of knowing what to throw away and knowing what to keep. Examine your own experience. How many times have you held a stock that should have been sold at 50, only to watch it drop down to 47, then 45, and then 40? How wonderful that your broker is there to hold your hand and reassure you it's still a $50 stock. Unfortunately, the rest of the civilized world is misinformed. Ever the optimist, your broker probably offered this swell idea if the stock was a good buy at 50, it's an even better buy at 40. So you didn't sell, and in fact, you compounded your error by engaging in that dangerous and destructive tactic of averaging down. You bought more at 40, telling yourself you'll now get out even when it gets back to 45. Months later, when that cheap stock at 40 became far cheaper at 25, the bad fundamental news that was really behind the drop belatedly became public. You ended up dumping the position for a huge loss as a stage 1 base was just about to start forming. Does this sound familiar? Never again will this nightmare be your destiny, because you will not be at the mercy of the stock as it plummets lower and lower and you keep hoping a bottom will form. Instead, you will be in control of the situation. You will take charge and get rid of any potentially crippling stage 4 stock, whether you have a profit or even or have a loss. Remember, the market is a mechanical, non-thinking entity that doesn't know or care what price you paid for the stock. So if it's going to be a loser, say goodbye. Otherwise, your profit will disappear, or your small loss will turn into a giant loss. Now let's go back to the chart 1-6, the XYZ stock. Note that it first broke down at 25.875. It then had an initial drop to 23. There are almost always one or more rallies back to the breakdown point as bargain hunters feel that the stock is cheap compared to recent prices they've seen. Thereafter, the downtrend gets going in earnest and the MA starts to decline. From a reward/risk point of view, this is the most dangerous situation you will ever encounter in the marketplace. Think how exciting and profitable it is that you will never be in this situation again. When you pick up your daily newspaper, you'll see that plenty of trading took place in that stock. Someone is buying. Just be glad that it won't be you. In stage 4, each decline drops to a new low while each reflexive oversold rally falls short of the prior peak. This is a textbook example of a downtrend. What's worse, All of this negative action takes place below the declining MA. Unfortunately, this is the stage where unsophisticated investors try to pick up a bargain because they think the stock has already fallen enough. But picking up fallen stars is a sure way to burn yourself. Take a look at Chart 2.5 of Levitt's Furniture from the early 1970s, and you'll see just how destructive such amateur bottom guessing in Stage 4 shaded area can be to your hard-earned money. Instead of falling into this trap, learn to read the chart and use the perspective it gives you to remain unemotional and disciplined in your quest for big profits. By the numbers. Now that you understand the concept of stage analysis, study these 4 charts and make sure you agree with the stage rating that each would get at this point in time. An important hint to remember is that the moving average is a great starting point for technically analyzing a stock. Now it's your turn. Here's a little quiz for you. Go over these stock charts slowly and rate each one as of their latest entry. Study them until you agree with me on their respective stage ratings, because a clear understanding of my method now will most definitely help you score profits later. The answers will be found following the charts. The real world. Now that you're starting to get it, let's study some real-life examples of Stage 2 powerhouse advances and Stage 4 disasters to see that it isn't a case of good in theory, but not in practice. Nothing could be further from the truth. While no method of predicting the market is foolproof, the results are so startlingly good that you'll find it hard to believe. In a future section, I'll show you how to minimize the negative effect of those situations that don't work out according to plan. Take a look at the 4 stocks in charts 210 through 213. All should have been bought when they moved into Stage 2, as recommended in the professional tape reader, See Arrow, when they broke out of their Stage 1 bases. Stare at Housing 210 completed an important Stage 1 base in early 1975 when it moved above 10. The MA then turned up, and it was a case of up, up, and away. Note how all corrections over the next 6 months held above the rising MA as the stock shot up to 24 within 6 months. A very healthy 280% annualized advance. ARA Services 211 also demonstrated that same winning pattern when it broke out above 30 on especially heavy volume in 1982. It shot ahead to the mid-50s within the next 9 months for a nice 100% annualized gain. Again, all corrections stayed above the MA. Telex 212 also broke out on extremely heavy volume when it moved above 10. It's no coincidence that the stock rocketed ahead for an incredible 680% gain, annualized over the next 3 months. Once again, note how handily all corrections were dealt with above the rising 30-week MA. Finally, of more recent vintage was our late 1986 recommendation of Micropolis 213, when it broke out above 19.50 on very impressive volume for a fast 250% annualized gain. This is the only one of the 4 that was not an example of buying as the stock moved from Stage 1 into Stage 2. Instead, Micropolis was a buy when it first moved into Stage 2 in early 1986, as it broke out above resistance at 10. Then it formed what looked like a potential Stage 3 top, between resistance at 19.50 and support near 15, before eventually breaking out a second time when it moved above 19.50 on very heavy volume. When this happens, which is relatively rare, the potential Stage 3 top bites the dust and the stock is put back into Stage 2. This is a powerful formation that is especially profitable for traders. So while longer-term investors want to do most of their buying near a base, when the risk is extremely low, traders should be alert for these continuation moves as they are usually very powerful and fast. Now here are some stocks, charts 214 through 217, that would have crippled your portfolio if you hadn't gotten out of them once they completed their Stage 3 tops and moved into Stage 4. Happily, all 4 were recommended for sale in PTR once they entered Stage 4. Back in 1973, Avon was one of many so-called one-decision stocks of that era. Many intellectually lazy money managers convinced themselves that the only decision they needed to make for these growth stocks was when to buy. Don't ever believe in such fairy tales. There is never an investment, whether it be stocks, gold, real estate, gems, or Naugahyde futures, that is a buy it and forget it situation. All investments go through cycles, and when you hold through the down part of the cycle, stage 4, you suffer both financially and emotionally. When Avon completed its top and moved into stage 4, it was earning $2.26 per share. Yet when it was trading at $80 per share less, the earnings were $2.30 per share for the trailing 12 months. If you fell into the trap of holding and rationalizing that it would eventually come back, then you should realize that, as I write, in late 1987, it's 14 years later and Avon isn't anywhere close to its high of 140 or the breakdown near 120. It's still struggling in the mid-30. Look at chart 214 of Avon and see how perfectly it followed the script with which you should be getting familiar. It broke support and sold off to 110. Then it staged one pullback rally back to the low 120s, where it originally had broken down. Thereafter, it was bombs away as stage 4 took over. Every rally over the next year failed under the declining MA, so all of the millions of shares bought, because it was cheap, at 80, and then 70, and then 60 in stage 4 were motivated by the destructive bottom-guessing syndrome. Never again will this be your fate if you learn my method and follow it in a disciplined way. Teleprompter 215 was another glittering favorite of that era as cable TV burst onto the scene. Despite the exciting fundamentals, Teleprompter clearly completed a major top when it broke below its MA and its important trend line. Once again, there was a sharp initial decline to 30, followed by a sucker pullback rally back to the breakdown level. Thereafter, Teleprompter headed south with a vengeance. All rallies failed at or below the MA as the stock lost over 90% of its value, confirming the old cliche, the more things change, the more they remain the same. The same dangerous pattern showed up in late 1986. This time, two new junior high flyers, Crazy Eddie 216 and Endotronics 217, were shot out of the sky during a super bull market. As if to prove the limitations of fundamental analysis, a major brokerage firm issued a buy recommendation on Endotronics just days before its collapse. Once again, things unfolded exactly as you'd expect. In both cases, there were important sell signals registered as stage 3 tops were completed. Again, after an initial decline, there was a pullback rally, and then the sell-offs really got rolling with all oversold rallies failing to move back above the respective MAs. I can guarantee you that similar situations will happen time and again in the future. The darling stocks of Wall Street will go down in flames, and the bargain hunters and other scavengers will crow about the great opportunities they represent. Your strategy should be clear: sell, and then avoid the stage for decline. In some cases, even sell them short, which we'll go over later, while the crowd builds up losses and then rationalizes that they are unlucky. You get the picture. By letting the market digest all of the relevant fundamentals, known and anticipated, and going with its judgment rather than what you read in the media and brokerage reports, your market batting average will improve considerably. The question that usually pops up at this point during my seminars is, can you apply this method to other areas, such as commodities or mutual funds? The answer is simple: absolutely. Anything that trades on a supply/demand basis can be charted and interpreted in exactly the same manner. Just be aware that when dealing with commodities or stock index futures, that the time frame is speeded up considerably, and a stage 2 advance may unfold in a matter of weeks instead of months. So you'll need to use a much shorter term MA. Now look at the chart of weekly spot gold prices, chart 218 versus its 30-week MA. Back in 1983, gold broke down from a stage 3 top formation down arrow and moved into stage 4 amid talk of eternal inflation and a $1,000 to $2,000 price. It crashed below $300 in the following months. In 1985, when inflation figures dropped to microscopic levels, and the crowd's expectations should have brought about a further drop to $150 to $200, a base formed, and the MA stopped declining. When it broke out above its gently down-sloping trend line, see up arrow, a new bull move was launched that took gold close to $500. Finally, this method is very helpful when you want to do mutual fund switching. It is particularly useful with both no-load and low-load sector fund trading. The sector fund is an investment vehicle that you should learn how to use. We'll go into detail about this later. For now, look at chart 219 and see how easy and profitable it would have been to have bought Janus Fund when it moved into stage 2. In September 1982, it was near 3.50 C arrow after completing its stage 1 base as it moved above its down-sloping trend line. By now, no matter how addicted you are to fundamental analysis, I hope that you see the value of my technical method. As the chapters go on, you'll become more confident and proficient in applying it. So keep reading, digesting, and reflecting. And the next time you hear someone quickly dismiss technical analysis as voodoo or worse, smile to yourself, but don't argue. It's important that investors disagree. If everyone used the technical method and had the same bullish or bearish opinion, they wouldn't be able to open the market tomorrow. Also, we need an uninformed majority if we are to realize outstanding profits in the market. Chapter 3. The Ideal Time to Buy. How, when, and what. In the past 2 chapters, you've already come a lot further than you realize. You can now take your portfolio and a chart book and go to work separating the good from the bad. Rather than blindly depending on your broker's advice, you can now quickly see which of your stocks have a high probability of success and which ones are very likely to give you an ulcer. Knowledge is power, and you are well on the way to becoming Hercules, but you still have some important learning to do. Now that the foundation is in place, you can easily differentiate between a bullish stage 2 stock and a bearish stage 4 situation. The next step, however, is to construct the rest of the building and to learn the perfect time to buy. In addition, it's vital to understand how you should go about purchasing your stocks as well as knowing what to purchase. This is extremely important since when you glance through a chart book, especially during a rip-roaring bull market, you'll see hundreds of stocks that look buyable. Therefore, it's absolutely crucial to learn how to cull out those few A-plus stocks with super upside potential while taking a pass on the lesser lights. Later in this chapter, we'll deal with the what to buy question, which is actually much more difficult than knowing when to buy. But first you have to master the next basic, which is knowing exactly where to enter a stock. When you see a chart of a stock that has had a major advance, there was one point that was the perfect time to have bought. This ideal entry point is what we are now going to focus on. The investor's way. There are 2 great times for an investor to do new buying, and both center around the breakout point. The first is when a stock initially moves out of its stage 1 base and enters stage 2. The second and safer time is when a stock pulls back toward the breakout point after the initial stage 1 buying frenzy burns out. The advantage of purchasing on a pullback is that you can play movie critic and judge what you've seen. Did volume pick up impressively? Did the stock move far above the breakout point? Did volume then contract on the pullback? Or did XYZ just nudge above the critical resistance level and then fall back below it, which always signals a red flag warning? Once you've watched the action, you know whether you're dealing with a potential A plus or C minus, so which tactic is best. Should you wait and only buy on a pullback? No. If you wait to do only such low-risk buying, you are going to miss out on some of the biggest winners. Those few stocks that never pull back are demonstrating the strongest rocket propulsion. These are going to be giant winners, so we most definitely do not want to be left on the launching pad. If you're a long-term investor, compromise and buy half of your intended position on the initial breakout, and the other half if the stock pulls back close to the breakout price and you like the post-breakout action. Chart 3.1 shows graphically what the process looks like. Point A is an excellent time to do new buying. It's an especially good entry point for investors. At this juncture, the risk is extremely low since the base of support is just underneath your purchase price. Equally important, the upside potential is tremendous since the entire stage advance lies ahead of it. The only drawback is that it can take time for solid stage 2 momentum to build. As with everything else in life, there are no free lunches, so it's a trade-off. You are getting a terrific reward-risk ratio but must often pay the price of patience. That's no big deal for an investor, but it can drive a trader crazy. So investors will do much more of this early stage 2 buying than will traders. That's the theory. Now let's look at a real-life example. Mexico Fund broke out at 3.25 C arrow on chart 3.2 in early 1987. Volume started to increase as the stock promptly jumped 35% in a matter of days. Once the initial burst of buying had run its course, it temporarily peaked at 4.375. 2 weeks later, it pulled back to 3.375, very close to the initial breakout. Volume favorably contracted on the pullback, so then is when you should have bought your remaining half of the position. Thereafter, volume increased sharply as it gathered momentum, and in the next 9 months chalked up a fast 330% gain as it rallied to 14. The trader's way. There is one other very profitable time to do new buying. It occurs after a stage 2 advance is well underway, when the stock drops back close to its MA and consolidates. It then breaks out anew above the top of its resistance zone, point A, on chart 3.3. This is called a continuation buy. Again, there is a trade-off involved. In this case, the probabilities are overwhelmingly high that the advance will be rapid, but there is a greater risk factor. This type of buy is more suited to traders than investors. But investors, too, should be willing to do some late stage 2 buying when the overall market is very strong and there aren't many initial breakout opportunities left. Early in a major bull market, however, there is absolutely no need for investors to do continuation buying since so many stocks are breaking out of their bases for the first time. Point 4, on the other hand, later in a bull market, such as in 1986, 1987, there are very few early stage 2 buys left, but plenty of the continuation variety still occurring. At those times, even investors should do some continuation buying. Chart 3.3 shows what this type of buy looks like. The moving average should be clearly trending higher. This is important. Just as a marathon runner needs something left in reserve for the finish, so does a stage 2 advancing stock. If the MA starts to roll over and flatten out, you don't want that stock. Even if it breaks out in a continuation move, it is not likely to have that tiger in its tank that we want. Instead, look for a stock that mimics the outline of this chart and has plenty of high-octane power left. Swift Energy provides a textbook example of what I'm talking about. After forming a multi-year stage 1 base, it broke out at 2.125 in early 1986, arrow at point A on chart 3.4. Over the next 6 months, Swift advanced very nicely to 5.375 for a better than 150% gain. The average investor, and unfortunately even some technicians, then started yelling that the stock was too high. Not true. In the following 5-month period, SFY consolidated its huge gain while the 30-week MA continued its non-stop journey higher. Then, in February 1987, Swift broke out from this reconsolidation area at 5.50, arrow at point B, and promptly rocketed ahead 240% over the next 4 months. Not so surprisingly, it never pulled back close to its 5.50 breakout point. Although about 80% of initial breakouts from a stage 1 base are followed by a handy pullback, this happens with less than 50% of continuation buys. This is especially true if the stock is going to be a grand slam home run. So the proper tactic when dealing with this type of breakout is to buy your entire position when it overcomes its significant resistance. While there are no official rules, I would say as a rule of thumb investors over the years should do about 75 to 80% early stage 2, buying with the remainder coming from continuation moves. Traders, on the other hand, should reverse the figures and do about 80% of their buying on breakouts that are already in stage 2 and have consolidated near the MA before breaking out once again. The rest of a trader's buying should be of the early stage 2 variety, under the microscope. Now let's slowly go through the process of how a stock completes its stage 1 base and moves into stage 2, so it will be absolutely clear exactly when you should do your buying. Look at chart 3.5 and note how XYZ is moving between support near 8 and resistance at 12. The basing action is all taking place close to the 30-week MA, which is no longer declining sharply, but has instead started to flatten out. When and if this stock breaks out above resistance at 12, that is the perfect time to enter the stock. But what if you are at work or on vacation when this exciting breakout occurs? Point A on chart 3.5. When you pick up the evening paper, frustration sets in. Zeiss closed yesterday at 11.50, closed tonight at 14, up 2.50 points, and you've missed it. The answer isn't to call your broker and buy at any price. You also don't have to run out and buy a quote machine or have your broker call you a dozen times a day. In fact, such so-called solutions will very likely hurt you. First, they lead to emotional decisions, and that is a definite no-no. I've always found that my most profitable judgments are made late at night or on weekends. This is no accident. It's a time when you can calmly decipher the chart's message with no wild Dow swings or broker's calls to affect you. Second, it's obviously important to concentrate on your primary business during the day. There's a far better, more relaxing way that will put less stress on you and lead to much bigger profits. And don't underestimate the importance of staying mellow, because the market is stressful under the best of circumstances. Using buy-stop orders. From now on, whenever you want to buy a stock on a breakout, use a buy-stop order. Some of you already know what this order is but don't use it. A few of you more experienced players do utilize it. Most of you not only don't use it, but aren't even quite sure what it is. All of that is going to change right now. Learning to properly use this professional technique is the next secret of profitable investing that you are going to master. From now on, you are going to use this order very often. What a buy-stop order does is tell the specialist that you want to buy stock XYZ. But, and this is an incredibly important, but only if the stock breaks out above a certain level. In the case of our ideal cycle chart 16 page 11, we want to buy only if the stock displays enough power to move above resistance at 12. By placing an order to buy 1,000 shares of XYZ at 12.125 stop, the stock will not be purchased if XYZ fails to break out above 12. If it does catapult above the critical 12 level, it then becomes a market order to immediately buy 1,000 shares of XYZ. You don't have to be watching the stock. You probably won't even know when your order is executed. Be aware, however, that it doesn't have to be filled at 12.125. The stock may be purchased at 12.125 or 12.25 or even 12.375. But, in the great majority of the cases, it will be very close to your ideal price. If, however, the stock is traded over the counter, you aren't allowed to place buy-stop or sell-stop orders. In that case, you have to work with a broker who will put your OTC stock on his monitor and buy it for you as soon as it pops above resistance. Using buy-stop orders is very important to your new market strategy. Before finishing up on this subject, there are a few important refinements to learn. Nothing in the market or life is ever all one way. As profitable as this technique is, there are a few potential dangers to be aware of. One problem with this type of order is that you can get a very bad execution. While this may not happen once in 50 trades, one bad time is one too many. Here's how to make sure that it never happens to you. Suppose stock XYZ closed last night at 11.625. You look at your chart and decide that it's getting ready to break out above resistance at 12. You call your broker the next morning before the market opens and put in an order to buy 1,000 XYZ at 12.125 stop. Unfortunately, right before the market opens, good news is announced on the stock, and it opens much higher at 15. Instead of getting in at your perfect entry price of 12.125, you are now the proud owner of XYZ at 15. While the purchase may ultimately work out, it isn't where you wanted to enter the stock. In addition, the reward-risk ratio is now far less favorable than it was at 12.125. Because of this potential negative, some traders and investors try to do an end run around the problem. They use what is called a buy-stop limit order with just one specified price. This means that you can buy only at your ideal price, in this case, 12.125, or not at all. I find this type of order an even bigger negative, as it creates more problems than it solves. Not once in 50 times, but more like 1 out of 4, the stock will break out without your ever buying it because it runs past 12.125 so quickly your order never gets filled. Buying within limits. What's the answer? There's a variation of the buy-stop limit order that very few market players know about. It combines the best of the stop concept, yet sets some higher limit to the price that you can pay. If we want to buy when crossing 12, we use a buy stop at 12.125, but also a limit of 0.25 point above the breakout, in this case, 12.375. We then enter the order as follows: buy 1000 XYZ at 12.125 stop, 12.375 limit. You'll buy the stock with no problem at all, unless it trades very thinly, in which case you'd stretch the limit to a half point above the breakout, and the order would read, buy 1000 XYZ at 12.125 stop, 12.625 limit. Again, you've lessened the ulcer factor because you don't have to worry that you'll end up paying a horrible price. Another potential problem is that you enter the order on Monday or Tuesday and the stock doesn't break out right away. Then you get busy and forget to enter it on Wednesday. Bingo. Murphy's Law, whatever can go wrong goes into effect and the stock makes its breakout. Your order isn't in and the stock ends up running away from you. Every market veteran has had this experience. There's an old market cliché that says the market will do what you expect, but not when you expect it to. It's absolutely true, and after playing the market game for years, I am now a firm believer in O'Toole's law, which states, Murphy was an optimist. So any tool that can reduce potential problems in the market should be considered valuable. That's why this next technique is so fabulous. It's simple yet very effective. When you do your market homework and see 2 or 3 potentially exciting patterns that you want to buy, if they break out, simply do the following. Enter buy stop orders for all 3 stocks on a good till canceled GTC basis. This means that you have a standing order with the specialist until you either cancel the orders or they are actually executed. Just be careful to keep good records. It's your responsibility if you forget about the order. You may be surprised 2 or 3 weeks later when you find out that you bought 2,000 shares of widget technology. Here's how your buy order should now read. Buy 1000 XYZ at 12.125 stop, 12.375 limit GTC. Using GTC stop orders will get you in the habit of doing several positive things. First of all, you won't have to watch the market closely during the day, which will allow you to concentrate your energies more clearly on your job. Second, you will make far better, less emotional decisions, since they will have nothing to do with that day's crazy market action. That's especially important with the ridiculous newfangled buying and selling programs that now often move the Dow up or down 30 to 50 points in an hour. Wild intraday swings can upset and panic you out of a perfectly good position, or sudden strength can cause you to scramble to buy something because it suddenly looks like the market is running away without you. Don't operate in this manner. It's crucial that you learn how to properly buy stocks in a disciplined, relaxed way. By using my method of stage analysis and combining it with GTC buy stop orders, everything will be automatic, which is just what we want to accomplish. Over the years, it has become obvious to me that the more mechanical I've made my system and the less subject to judgments and emotions, the more profitable it has become. Interestingly enough, this subtle but important fact has been reinforced by dozens of Wall Street pros with whom I've talked who have learned the same lesson, often the hard way. Why should this be so? Simple, because we all are human and filled with an abundance of those twin demon emotions, fear and greed. Fear causes you to panic and sell at the bottom, while greed motivates you to buy right near the top. These are the driving factors behind the crowd's yo-yo mentality. In order not to get caught up in the fear-greed syndrome, set time aside each weekend to unemotionally scan your chart publication. You really only need an hour for this chore, but obviously the more time you can spare, the better. Make up a list of the few outstanding potential buys that you see among the many charts. Then, each night, chart and follow these few stocks plus any other issues in your portfolio. This simple exercise will help you develop a much more sensitive market feel. In addition, instead of being overwhelmed and continually whipsawed, you'll feel relaxed and confident as you follow your profitable game plan. Buying and selling patterns to be aware of. Before getting into the specifics of what to buy, there are a few market patterns that occur with such unbelievable regularity that you must become aware of them. They will give you an extra edge in determining when to be more or less aggressive. It's especially important for traders to know these repetitious patterns, but even investors can raise their batting averages by being aware of these tendencies. While many of us technicians have done work in this area, no one to my knowledge has engaged in the in-depth research that Arthur Merrill and Yale Hirsch have. Merrill's book Behavior of Prices on Wall Street, Analysis Press, 1984, and Hirsch's book Don't Sell Stocks on Monday, Facts on File Publications, 1986, are excellent works on the subject. In the next few pages, with their permission, I am going to borrow heavily from their excellent data so you can better understand these important recurring patterns. The first cycle that you should be aware of is the most important. This is one that both traders and investors alike should be thoroughly familiar with, the 4-year presidential cycle. Many investors mistakenly believe it is best to wait until after the election to buy. They reason that Wall Street prefers a Republican, business-oriented administration, and the market will decline if a Democrat is elected. This is wrong on 2 counts. First of all, the Dow Jones Industrial Average has actually racked up more points in this century under Democratic presidents than Republicans. Some of the gain, however, is due to greater inflation during the Democratic time in office. But even more important is the reality that no matter who is elected, the year following the election is usually a disaster. Bear markets have been as common as presidential candidates kissing babies. It's therefore not surprising that first years such as 1969, 1973, 1977, and 1981 all witnessed bear markets. There are exceptions, of course. 1985 was a bullish year. Historically, the probabilities are strong that in the second year the bear market will continue until a bottom is reached around mid-year, as occurred in August 1982. The rest of year 2 is bullish, and then the third year of the presidential term is the best one of the cycle, 1987, until late August was no exception. The fourth year, which is the election year, is a choppy one, with weakness usually occurring in the first half and strength in the second half. Over the past 100 years, this 4-year cycle has unfolded with such unbelievable regularity that it almost seems as if the politicians are writing the script. After all, any president wants to be re-elected, so it makes sense to stimulate the economy in the 2 years before the election. Conversely, they usually deal with whatever negatives there are immediately following the election. Then there's plenty of time for the economy to strengthen before they have to run again. So, while you should always keep a close eye on the market indicators, it's especially important to do so in the period following an election. Another historical pattern is the market's behavior month by month through a typical year. According to Merrill's data, over the past 80-plus years, December has been the best performing month. He based his results simply on whether or not the DJ Industrial Average posted a gain for each given month. December was a winner 68% of the time. In addition, Chart 3.7 shows that the 3-month period of November, December, and January has the strongest bullish bias of any 90 days in the market year. This demonstrates that the year-end rally is no myth. July and August are also positive, which supports the idea that there really is a summer rally syndrome. At the same time, February, May, June, and September have a horrible record and are times to go easy unless the charts and indicators are strongly positive. In his book, Yale Hirsch did some interesting studies based on the percentage gain or decline of the Standard & Poor's Composite Index since 1950. Overall, his conclusions closely parallel Merrill's, but there are a few noteworthy differences. While he too showed the November-January period to be highly bullish, November actually nosed out December for first place. In addition, April scored quite well, as recent years have benefited from IRA buying. The poor months, however, still turn out to be February, May, June, and September. Now let's look even closer under our microscope at the days of the week. Once again, reality and myth collide. The average investor believes that after a weekend of fun and sun, the market is ready to run higher on Monday. Then, since they've heard it repeated so often, they expect the market to sell off on Friday. The rationale is that traders are supposed to dump stocks before the weekend, so they don't have to worry about weekend news events. This is absolutely wrong. See Chart 3.8. As Yale Hirsch's figures indicate, Monday is the worst day of the week while Friday is the strongest. In a bear market, Monday is especially horrible, which is why it has been dubbed Blue Monday. But even in a bull market, it's sure not anything to get excited about. Finally, there's one more misconception to clear up concerning the holidays. As Arthur Merrill states in his book, newspaper headlines often read something like, "Market rallies despite holiday, advance runs contrary to the usual pattern of selling before a long weekend." This too is wrong. The facts are quite the opposite. The day preceding a holiday is usually a bullish one. Overall, the market rises about 68% of the time on such days. Obviously, if a favorable breakout occurs on a Monday or in May, it should still be bought. Nevertheless, it's worthwhile when fine-tuning your portfolio to learn these significant patterns that I've condensed for you. It will be beneficial to know when to be just a bit more or less aggressive, and it can help you develop pinpoint precision in your buying and selling. Take the time to become familiar with these patterns. It will be time spent profitably. What not to buy? Before moving on to the next very important topic, what to buy, I want to make sure that you know what not to buy. A very common mistake made by amateur technicians, and surprisingly, even by some professionals who should know better, is to buy when a stock breaks out above its base, even though it is still below its declining 30-week MA. This is not a stock that you want to purchase, since it is not yet ready to start a sustainable advance. In most cases, there will be a temporary rally for a few weeks, then the stock will falter. On a best-case basis, the stock will undergo additional basing as the MA flattens out. On a worst-case basis, it will break below the bottom of the trading range and start a severe new down leg. Here are two examples from the 1973-74 bear market that illustrate exactly what I mean. Western Union got smashed badly in 1972 as it dropped from 68 down to 44. Then the bargain hunters came in and did their thing. Over the next several weeks, a possible base started to take shape, Chart 3.9. The foreshadowing that it was doomed to failure was given by the 30-week MA, which continued to decline throughout the potential base formation. Also critical was the fact that the breakout point A from the trading range occurred below the MA. Even though WU later edged above its MA, the fact that the initial breakout took place below the MA was an additional warning sign. It was an even more serious red alert that the MA never stopped heading south. Never buy a stock in this position, no matter how cheap it looks. Now look closer at the chart. Over the next year and a half, the stock that looked cheap near 45 became far cheaper as it fell to 8.50. Study Cannon Group, and you'll notice that the same sucker pattern unfolded. Again, the stock looked cheap after dropping in a hurry from 45 to 22. A trading range then took place in 1986 between 27 and 22. Throughout all of the trading range gyrations, note that the MA continued to head south, Chart 310. When Cannon Group broke out above 27.A, you should not have considered buying it for even a moment because the breakout was below the MA and Cannon never even edged above the MA. In addition, the MA continued to decline relentlessly. The predictable result was that Cannon Group turned out to be no bargain at either 27 or 22. 6 months later, it was trading at 4.125. What to buy? My forest to the trees approach. Just as important as when to do new buying is what to buy. This is actually a far more complicated decision to reach. Once you digest the ideas in this section, it too will become routine. It is really a three-part equation that I call my forest to the trees approach. What I mean is that you should work from the large question, how's the overall market, down to the smaller component, which stock looks best to buy. In between those two extremes is the middle part of the equation, which group is acting best technically. So the process unfolds in the following manner. 1. What's the trend of the market? If it's negative, you'll want to do very little if any buying, even if you see some stocks breaking out. Your probabilities of success are quite low when the market trend is going against you. 2. Which few groups look the very best technically? The importance of this question can't be overemphasized since my studies have consistently shown that two equally bullish charts will perform far differently if one is from a bullish sector, while the other breakout is in a bearish group. The favorable chart in the bullish group will often quickly advance 50 to 75%, while the equally bullish chart in a bearish group may struggle to a 5 to 10% gain. 3. Once you determine that the market trend is bullish and Group A acts the very best technically, the final step in the process is to zero in on the one or two best individual chart patterns in that sector. If you follow this three-step process, you will find yourself heavily invested in the best acting stocks when the market is powering ahead, and sitting on large cash reserves when the overall trend turns bearish. How to implement the strategy? That's the theory, and it's a profitable one. But now you must learn how to execute it. As usual, the starting point is the market itself. To determine if the market is technically strong or weak, you can't just tune into the 6 o'clock news and hear if the Dow was up 30 points or down 40. Unfortunately, many investors do just that. Such a surface approach will lead to whipsaws and guaranteed losses in the market for two very important reasons. First, the day-to-day action often disguises the market's real trend. You'll often end up mistaking a short-term move for the major trend. Second, even if you luck out and identify the trend of the Dow Jones Industrial Average, the subsurface condition of the market is often moving in an opposite direction. A perfect example of what I mean can be seen by looking at chart 311 of the Dow Jones Industrial Average in 1982. From the beginning of the year through the mid-August low, the overall market trend was lower. At the same time, however, the percentage of bullish charts on the New York Stock Exchange was slowly but surely improving. This was just one of many key indicators that caused me to turn bullish in July 1982. 1 month before the Dow launched one of the great bull markets in history. While the market averages were forecasting lower prices, the majority of my technical gauges were signaling that a new bull market lay ahead. Did the market have to turn? Of course not. The market, as we all know, is perverse and doesn't have to do any given thing. However, if you play the winning percentages, you'll be right better than 8 out of 10 times. That is a fine batting average when dealing with the future. The way to gauge the market is by letting the trusted indicators unemotionally decide for you. I'm not going to teach you the indicators now since I want to cover them in detail later on. For now, we'll assume that the trend is bullish. After you read Chapter 8, you'll be able to spot the next important market top and bottom, selecting the sector. After reviewing the market indicators and confirming that the overall market trend is bullish, it's time to move on to the next step. Zero in on the one or two groups that contain the most exciting upside potential with minimum downside risk over the next several months. This exercise isn't just important, it's a crucial one. After years of observing and studying market cycles, there is absolutely no doubt in my mind that sector analysis is just as important as overall market timing. In fact, in certain markets, it is even more important. For example, in the 1977 two-tier market, which saw the blue chips undergo a bear market while the secondary stocks advanced. So where do we start when analyzing groups? Most definitely not by reading the fundamentals. Back in 1982, when I turned bullish on the mobile home group, see chart 318, the earnings were lackluster, yet they led the 1982-1983 hit parade on the upside. About the same time, in early 1981, oil stocks were being touted to the moon as the price of oil zoomed to $38 per barrel. There were reports that it was going to reach $100 amid horrible shortages. The charts, however, told a very different story. Major stage 3 tops were forming on the majority of oil charts and on the group chart itself, chart 312. So rather than listening to the optimistic fundamentalists, the proper strategy was to start locking in profits. The rest is history, as the group crashed over the next several years. The place to start this next level of learning is the charts themselves. To do this, we are going to scan the Standard & Poor's weekly industry charts. This important input is also covered in the Mansfield Chart Service. The only difference when studying an industry rather than a stock chart is that the group graph doesn't have volume plotted on it. Other than that, everything else is exactly the same, as you can see from charts 313 and 314. First, check what stage the group is in. Chart 313 shows that, in 1987, chemicals were in a powerfully bullish Stage 2 uptrend, while electric utilities were in a Stage 4 downtrend at the same time. Therefore, no matter how bearish an individual stock pattern appeared in the chemical sector in the first half of 1987, I wouldn't consider selling it short. 12 in the same manner. No matter how bullish a stock appeared in the electric utility group in March 1987, I wouldn't consider buying it. One other reality this makes very clear is that you can easily lose money if you're in the wrong groups, even when the averages rocket ahead, as they did in the first half of 1987. When dealing with groups, use the same criteria that you do with stocks. Investors should concentrate their buying in those market areas breaking out of Stage 1 base patterns, while traders should lean toward continuation moves in already existing Stage 2 uptrends. There is one difference, though. If the group is already in a well-established Stage 2 uptrend and is far above support, an investor wouldn't normally be in a big hurry to buy that pattern if it was a stock. But if the group is already well into Stage 2, and you find a stock from that sector first breaking out of its Stage 1 base, then it's fine for an investor to buy that particular stock. In the same manner, if a trader saw a continuation pattern buy that looked good in a group that had just moved into Stage 2, the trader can definitely buy that stock. The most important factor when dealing with groups is that the sector be healthy. That is, not in Stages 3 or 4. All things being equal, however, the very best situation for an investor is a stock that is an early Stage 2 breakout in a group with the exact same pattern. For a trader, the ideal is a continuation breakout within a dynamic group exhibiting the very same sort of pattern. A second group signal is available by scanning the charts themselves. When you go through your chart book, if you see several stocks from one group that are suddenly turning bullish or bearish, that's a clear-cut signal. Make a list of the very best chart patterns with the sector designation. If you have 6 groups that have bullish Standard & Poor's charts, but most of your potential big winners are from 1 or 2 industry groups, that too is telling you something important. While all 6 groups will very likely advance, the one with the several excellent chart patterns will turn out to be the A+ of the batch. This approach also helps keep you on the track in another way. At times, the Standard & Poor's industry charts are distorted by one stock in a given group undergoing a powerful advance or decline. By using this cross-check method, you won't be thrown off because one stock is a takeover candidate or is a special situation that is suffering. Here's how it works. Back in the good old days of 1978, I noticed unusual strength appearing in the individual casino stock charts, while the hotel-motel and the leisure time groups also showed fabulous technical strength. In addition, their respective relative strength lines were all extremely bullish. Furthermore, there wasn't a casino stock that had a bearish chart pattern. With all the buyables to choose from, I felt like a kid in a candy store hardly knowing which to choose. It's unusual to see such incredibly broad strength or weakness touch every stock in a sector, but when it does, don't overlook the obvious message that the market is giving you. Starting in late March 1978, I went on a casino recommending spree. Over the next 2 weeks, I recommended Bali, Caesars World, Harrah's, Holiday Inns, and Playboy Sea Arrows for buy points. They scored a grand slam home run by advancing between 105% and 560% over the next few months. The mobile homes sector also exhibited that bullish 1-2 punch in the summer of 1982. The industry chart broke out of a powerful Stage 1 base pattern. The relative strength line was bullish and all of the mobile home stock charts looked great. So between early June and mid-August, 8 mobile home stocks were recommended in PTR: Coachman, Fleetwood, Oakwood Homes, Phillips Industries, Redmond, Skyline, Winnebago, and Zimmer see arrows on charts for buy points. This group was a bullish fantasy over the next year as it rocketed ahead for an average 260% gain. Don't make the mistake of thinking that these stocks were great just because a new bull market was getting underway. Sure, that helped, but if you didn't do your technical homework, you could have fallen into the fundamental trap of buying a low P/E stock such as Warner Communications, 322. It's a perfectly fine company, and in the summer of 1982, as the market was launching its new bull phase, the latest 12 months trailing earnings were a nifty $4.35, and WCI was only a little more than 11 times earnings. If you bought it in mid-1982 instead of the mobile, home stocks, 1 year later you'd have suffered a spanking 60% loss instead of a 260% gain. Was there any technical foreshadowing which warned you to stay away? There sure was. Look at chart 321 of the entertainment industry. It broke below its MA in the summer of 1982 while the mobile home sector was breaking out on the upside. Furthermore, the relative strength line was weak and actually dipped into negative territory that summer. Finally, its individual chart components were mixed, with some looking okay while others, such as Warner Communications, looking horrid. Note that Warner Chart 322 broke down that summer into Stage 4, while most other stocks and groups were moving into Stage 2. Even after its first vicious crash in 1982, more trouble lay ahead. Its sharp oversold rally in late 1982 took the stock from the low 30s to 60. The rally, however, failed right at the bearish trend line. Thereafter, the bargain hunters were really punished as Warner plummeted to 20. The game never changes. Charts 323 and 324 show a group and stock pattern of more recent vintage with similar results. Starting in August 1986, I turned bullish on the oil sector. The group broke out above significant resistance, and the relative strength line shaped up nicely and moved into positive territory. Finally, the overwhelming majority of individual oil charts were screaming buy. Interestingly enough, crude oil was near $10 a barrel, and there was worry that it was on the way to $6 to $8 per barrel. This was the mirror image of early 1981, when oil had great headlines but poor technical underpinnings. It's also an outstanding example of contrary opinion in action. It was therefore no surprise that every one of the dozen plus PTR oil-related recommendations, oil drilling, and oil equipment, made in that period turned in winning performances, with several, such as American Oil and Gas Chart 324, being spectacular. Then, in December of that year, the computer stocks started popping their modems, and this was the next area in which to start doing aggressive buying. The industry group completed a Stage 2 consolidation near the 30-week MA chart 325 when it broke out above significant resistance. In addition, the relative strength line was nice and peppy. It moved to a new high in addition to being in positive territory. Another added plus was given by the long-term background chart as the group registered a new all-time high. Finally, several individual stock patterns in that group staged powerful upside breakouts, see chart 326. When all of these important factors check off positively, don't walk. Run to your telephone and start giving your broker the buy orders as fast as you possibly can. Every year, there are a few groups that far outpace all others on both the upside and downside. By following this step-by-step approach, you will be able to position yourself in the few that lead the hit parade. At the same time, you'll avoid the downside disasters. And when the market climate is bearish, you will profit by selling short the weak sisters from the vulnerable groups. Don't underestimate the importance of group confirmation. I've seen countless examples of good-looking stock charts that turned in only ho-hum performances. When I checked out the group pattern, sure enough, it was usually in poor shape. On the other hand, I've seen many chart patterns that were good, but not great, that turned out to be super performers when they had the backing of a powerfully bullish market sector behind them. I've also witnessed many cases of stocks in weak groups that got bombed even when the overall market trend was bullish. Don't ever rationalize that it's a bull market so the stock will eventually work out. Here's a perfect example of what I'm talking about. Despite a better than 600 points advance in the DJI from late 1986 until summer 1987, the Real Estate Investment Trust Group acted just horrid. Chart 327. Lomas and Nettleton Mortgage, along with many others from the group, dropped significantly during the first 6 months of 1987, while the market averages rocketed higher. Chart 328. Here's that old fundamental trap in action, which will never again snare you. The P/E ratio was low and the company a good one, so how could it miss? Easy. Because the group was negative and the individual chart pattern was in the dangerous stage 3 phase as the new year started. Then, once it broke below support at 29.50, it moved into stage 4 trouble. Finally, the relative strength line was a disaster. With these negative ingredients, it's easy to see why the stock dropped over 30% while the Dow moved ahead spectacularly. Another example of the negative group effect can be seen by studying the action of the brokerage group in 1987, Chart 329. Whereas Lomas and Nettleton Mortgage was a bearish stock in a negative group, McDonald & Company Investment was a moderately favorable chart that staged a false upside breakout, point A, in early 1987, Chart 330. Whipsaws such as these are quite common in a negative group. It wasn't a great surprise that the stock went nowhere fast on the upside, and then became another wrong-way Corrigan as it declined during one of the great bull market rallies of history. The lesson is obvious. Don't try to be a whiz kid and attempt to find the one winner in a sick group. Don't try to prove you're a market genius. Let the so-called geniuses lose their money while you very simply find an A-plus stock in an A-plus group. Then just enjoy the ride and the big profits. Chapter 4. Refining the Buying Process. Now that we've learned to first check the market's major trend and uncover the few best groups, we are ready for the ultimate step. It's now time to narrow our choice down to a single buy candidate from the positive sector. How do we determine which one or two stocks from that group should be purchased? Is there really a way to predict which issues are likely both to go up and turn in an A-plus performance? There definitely is. While no system will ever be a perfect forecaster of the future, we can learn some simple rules that will put the probabilities of success strongly in our favor. The less resistance, the better. I've already explained the concept of resistance, but let's quickly review it again and then delve deeper. This is going to be very important to your future batting average, so we'll go over it carefully. On Chart 4.1, stock XYZ formed a trading range in the 18 to 20 zone after undergoing a severe decline. The area near 18 became a temporary floor of support while this trading range was in existence. On the upside, since rallies failed near the 20 level each time they attacked that price, 20 became resistance during the trading range. Then, after several weeks of zigs and zags within this neutral range, XYZ broke below the 18 support level. This, of course, was a negative indication and signaled the start of a new decline. After this new bout of weakness, XYZ stabilized at a low of 13. It then moved into a new trading range and built a solid base. New support was now at 13 and resistance at 15. Finally, it overcame the 15 resistance and, more importantly, also advanced above the MA. You are now seasoned enough to know that this stock is a buy. But do you want to purchase it? Not necessarily. Even though the probabilities are very strong that this stock is going to advance and you'll make money, that isn't enough. At first, this may sound crazy to you. I wouldn't be surprised to hear you say, "What is Stan talking about? I've bought a bunch of dogs that have gone down before I've gotten my confirmation slip. Now he's telling me that this stock is going to advance and I shouldn't buy it." Just think along with me one step further, and you'll see that I haven't taken leave of my senses. It won't be a terrible thing if you buy stock XYZ. You'll make money in it. But I want to do more for you than just make money. We both want you to make big money. There's a concept in economics called opportunity costs, which applies perfectly here. Taking away all of the fancy ivory tower jargon, it means that we all have limited resources, whether it be $25,000 or $25 million. So we must maximize our resources, which, in this case, is your market stake. If we buy stock XYZ and it advances 20%, but stock ABC in the same time period gains 200%, we have actually lost profit-making potential. Therefore, what we want to do is to uncover the A+ stocks and play those while leaving the BS and CS alone for others. Now go back to chart 4.1 and I'll show you why this is a B buy. Once XYZ gives a positive signal by breaking out above 15 resistances, you must look at where the next area of resistance is. It's 18, which was the floor of support from the prior trading range. Remember that support, once broken, later becomes resistance when the stock rallies back to that level. If XYZ does overcome that resistance, it will find the going very tough all the way up to 20. So the entire 18 to 20 area presents significant potential resistance. That doesn't mean the stock will never overcome that area. What it does mean is that it will use up a great amount of buying power to get through this zone, so it will most likely stall in that area for quite a while. Even in the unlikely event that it gets past the resistance in a hurry, it will be tired and need to regroup. It's no different from someone who has to climb 6 flights of stairs to get to their apartment versus another person who can simply take an elevator, who is obviously going to have more energy left. It's the same with stocks. If stock XYZ and ABC both stage breakouts and then benefit from 500,000 shares of buying in the next several sessions, which one is going to go further? The one with little or no resistance in its path, or the one with plenty of overhead supply? The answer is obvious. So now let's look at chart 4.2 of stock ABC. It's in the same group as XYZ and is also breaking out above resistance, and it's MA. Whereas XYZ had a clear zone of resistance just a few points overhead, ABC has no overhead resistance on the chart. While it may have traded at higher prices, it hasn't done so in the past 2+ years. The Mansfield chart shows the history for about 2.5 years. While resistance is still in existence even from several years ago, my studies have shown that the older the resistance, the less potent it is. This makes sense since resistance is created by sellers who bought at higher prices and want to get out close to their purchase price after the stock declines. As time passes, more and more investors take their losses at the end of each trading year, so if it doesn't show up on the chart, it's no big deal. There is one last step to this exercise. Check the long-range perspective on the Mansfield chart. This is a high-low bar chart of each of the past 10 years. If there is no resistance, it hasn't traded above this price in the past 10 years on this chart, then you should really get excited because you are looking at an A+ situation. Here are some real-life examples that reinforce the theory. Look at chart 4.3. When Alligiz Corporation broke out above the top of its 1-year trading range in 1987, there was no further resistance on the chart. Then, when the long-range perspective was checked, the green lights really started to flash. There was no resistance, see arrow on long-range perspective, above that level in the past 10 years. It's no surprise that AEG rocketed ahead a fast 30 points because the buying met absolutely no resistance. Whenever a breakout occurs with a stock moving into virgin territory, it's never before traded there. This is the most bullish situation you can buy. Think about it. There isn't one person who is long and has a loss. Nobody wants to get out even 1 or 2 points higher. So the buying power can really have an explosive effect on prices. Now look at chart 4.4 of Pan Am Corporation from the same bullish airline group in 1987. Even though it broke out of a base pattern and moved above its trend line in MA, it shouldn't have been mentioned in the same breath with Alligiz. There was resistance near 6.50, where the rally failed in late 1986. Even worse, there was heavy supply near 7 where PN broke down in early 1986 as it then got smashed down to 4. Finally, when you check out the long-term perspective, it becomes obvious that there was very significant resistance just above 8. Between 1983 and 1986, PN topped out above 8 in each of the 4 years. Whereas Alligiz was an A+, I'd grade Pan Am a C. Remember, if you had to do something with the stock, PN would be a better buy than a sale. But you don't have to bet every race. And you don't have to buy every stage 2 stock, only the outstanding ones. Are you starting to see what you should be looking for? It's not enough to find a stage 2 stock, even in a good group. There are several other factors to check, which we'll get to in a moment, but one of the most important is where overhead resistance is situated. Here's another case history that will reinforce the proper techniques to use. Reynolds Metals is in the aluminum group, which was in great shape in 1987. In early 1987, RLM flashed a very bullish signal as it broke out on the upside from a one-year trading range. One quick glance at Chart 4.5 shows that there was no resistance overhead for the past 2.5 years. Then a bit more digging via the long-range perspective chart showed that this was a new 10-year high. Bingo! Your buy order should have been sent in a hurry because the chart fulfilled all of the criteria that we've been stressing. Within a few months, the stock was a fast double as the heavy buying met no significant resistance along the way. Now contrast that action with the breakout that occurred at almost the exact same moment in another member of the group, International Aluminum, Chart 4.6. IAL broke out when it moved above 20 in early 1987. But unlike RLM, International Aluminum had plenty of resistance just overhead, near 24.50. Not only was that the high early in 1987, but also in 1986, 1985, and 1983. So what happened? Instead of moving out with a bang as Reynolds did, it advanced with a whimper, and after a fast advance to 24.50, it quickly fell back to 20. Other problems with the pattern were ho-hum volume after the first week, mediocre relative strength, and a relatively small base pattern. 6 months later, you would have been even while Reynolds would have more than doubled your money, which is better than a 200% annualized gain. The message is obvious. Always check where and how much resistance is overhead on any stock before you pick up the phone to dial your broker with a buy order. The importance of volume. The next important factor to concentrate on is volume. Once you learn to spot this telltale clue, you'll be well on the way to separating the so-so buys from the explosive big winners. Even if we never were to discover the reason why volume is so important, a quick perusal of any chart book would convince you that volume confirmation on a breakout is crucial. There is, however, a very good reason why volume signals really work. Volume is a gauge of how powerful the buyers are. As I said earlier, stocks can fall of their own weight, but to advance it takes plenty of buying power. It's no different from pushing a boulder up a hill. It takes a tremendous expenditure of energy to move it up the hill, but once you let it go, it can build up plenty of downside momentum on its own. The rule is very simple. Never trust a breakout that isn't accompanied by a significant increase in volume. Chart 4.7 shows exactly how a technically healthy pattern should unfold volume-wise. When the stock is in the base area, the volume pattern will be erratic. My studies have led me to a different conclusion than many technicians. Some believe there must first be a spike that shows the final panic dumping of the stock. They feel that volume should then contract, dry up, showing a lessening of selling pressure. While this is a nice theory, I've seen far too many charts with far different volume formations that turned out to be big winners. So to keep things simple yet profitable, I wouldn't worry what shape the volume pattern takes while it is forming a stage 1 base. However, once XYZ breaks out above the top of its resistance area and moves above its 30-week MA, I want you to worry plenty about volume. As Chart 4.7 shows, volume should pick up significantly on the breakout. If it doesn't, the probabilities are very high that at best, you've got a mediocre winner on your hands that will advance only a few points. At worst, the stock will turn out to be a false breakout that will soon be back in the trading range. Investors always want hard and fast rules, and too often we technicians are guilty of complying. I don't agree that there is a magic level of volume necessary for identifying a winner. Rather than looking for breakouts that have a randomly picked number such as 4.65 times the average volume of the past few weeks, I look for the following. Either a one-week volume spike that is at least twice the average volume of the past month, preferably, it is even higher. Or a volume build-up over the past 3 to 4 weeks that is at least twice the average volume of the past several weeks coupled with at least some increase on the breakout week. Whatever the exact number, if there is no significant increase in volume when the breakout occurs, then avoid that stock. If you have purchased it with a buy-stop order, then sell it for a fast profit when it advances after the breakout, which it will usually do. Here are some real-life examples of volume, or the lack of it, in action. Chart 4.8 shows that when Allied Signal broke out, there was no great increase in volume. The average volume for the past 4 weeks had been under 20,000 on the chart. 2 zeros are dropped, so its actual volume was about 2 million shares for the week. On the week of the breakout, volume did not even reach the 40,000 level, let alone exceed it. This was a sign that buying in the stock wasn't powerful enough to take it past resistance near 50. Therefore, it wasn't any great surprise when ALD pooped out at 49.25. If you had bought it with a 43.625 buy stop a few weeks earlier, you should have taken your fast profit near 49 as it neared its 1986 high. Now contrast this ho-hum action with the breakout that occurred in another area of the Dow 30 blue chips, Goodyear Tire and Rubber, in late 1986. Chart 4.9 shows that exciting buying entered on the GT breakout. The average weekly volume for the prior 4 weeks was approximately 22,000, but on the breakout week, it was almost triple that figure. And then it grew larger and larger over the next 2 weeks. That's A-plus action. GT then pulled back close to the MA near 40 a few weeks later. Note that there was another bullish signal given on the pullback. Volume contracted by over 75% from peak levels. If trading had remained at peak levels, then you would not have done any further buying. However, this was not the case. With the tremendous increase of volume on the rally, followed by the very dramatic drying up of volume on the pullback, the stock was shouting as loud as it could to buy more. You then should have bought the other half of your position in the low 40s. Here is one more case that will help you master this very important profit-producing concept. Both stocks in this pair, charts 410 and 411, are from the same market cycle and the same group. Yet one racked up a 300+% gain, while the other produced a loss. The answer wasn't in the stars, it was in the volume. Puerto Rican Cement, chart 410, had an average volume of 120 for the 4 weeks prior to its breakout at 9 in early 1986. Volume then expanded tenfold, which showed that somebody was suddenly urgently wanting to buy. These somebodies were right, because the stock they grabbed at 9 sold at 38.50 only 15 months later. Texas Industries, chart 411, was another cement stock that broke out in early 1986, but this stock fizzled rather than sizzled. Instead of expanding, volume actually contracted and stayed well below its high of the past few months. This was a good reason to pass on TXI and not buy when it moved above 31.50. The volume signal would have saved you, because a few months later, TXI was down to 22 while Puerto Rican Cement rocketed higher and higher. There is much more to learn, but let's stop for a minute and go over some of the key points that we now know to look for. First, we want the market trend to be bullish. Second, the groups should be positive. In addition, the chart from that favorable group must be breaking out into stage 2 with a minimum of resistance overhead. Finally, volume most definitely must confirm the breakout. Look at how many checklists we have, and how you can separate the good from the bad and the ugly. There's so much to learn when using technical analysis, yet so very often some academic economist will come along and tell you that charts don't work and the market is random in its trading. Years ago this used to upset me, but now I laugh to myself. Do all of these moves look random to you? And how can you crank 1,000 breakouts into a computer and treat them equally, as if they were all A-plus moves? It would be comparable to averaging the distance that all quarterbacks can throw a pass, from a Dan Marino and a John Elway to a Little League player. But that's okay. These random walkers will be selling their stock to us on the breakout, so we'll let them think charts are akin to voodoo as they buy into stage 4 stocks that drop lower and lower. It's all relative. The next important factor to check out when narrowing down our list of potential buys is the relative strength, RS. This is a measure of how a stock is acting in relation to the overall market. Even if a stock is rising, it can show poor relative strength. Likewise, a declining issue can demonstrate positive relative strength. Think about it. If XYZ rises by 10% while the Standard & Poor's Composite advances by 20%, XYZ is lagging badly even though it is moving higher. Not only isn't it a leader, but it obviously is being pulled reluctantly higher. Therefore, the probabilities are very high that when the overall market turns down, XYZ will get bombed. Conversely, if it drops by 10% while the market averages plummet by 20%, then it is putting on a good show of relative strength. And once the market turns higher, this stock will likely lead the hit parade. The formula for relative strength is a simple one. Price of XYZ divided by price of market average. If stock XYZ is currently at 50 and the S&P composite average is at 310, then its relative strength is 1650 divided by 310. Some technicians calculate this figure every day, but I've found it to be unnecessary. If you do it once a week 7, you'll see a clear-cut pattern forming over time, and that's what is important. One week the relative strength can be positive, while the next week it is negative. The true picture forms only over a period of time. Chart 412 shows the price of XYZ on the top portion of the chart, with the corresponding relative strength for XYZ at the bottom of the graph. Note that while the price action of the stock is neutral, moving in a 51 to 55 trading range, the relative strength line is telling a different story. It's favorable that the RS line is trending higher. The probabilities favor an upside breakout from this neutral range. On the other hand, even if the stock fools us and breaks out on the downside, we do not want to sell this stock short. Whenever an issue exhibits superior relative strength, it is telling you loud and clear that its downside action will be limited, so look elsewhere for a short sale. If you own the stock, however, you must still respect the breakdown and get out. There's an alternative to keeping up your own RS graphs. Some chart services include relative strength on the graphs. Look at chart 413, see arrow, and you'll see where the Mansfield chart service plots relative strength. They use a complex weighted formula, but the results are the same. When you see inferior action in the RS line compared to the price performance, don't ever buy that stock. Conversely, when you see a very positive relative strength trend, do not consider shorting it. Mansfield's relative strength also has a zero line, see chart 413 on it. Above zero is a long-term positive, while below zero is a long-term negative. While it happens rarely, it's an important long-term plus if all of the positives on our checklist, group confirmation, minimum resistance, heavy volume, and so on, are met, and at the same time, the RS line moves from negative to positive territory. For short selling, which we'll cover later, the opposite is true. A break below the zero line is an important negative when all of the shorting criteria are present. Don't think, however, that you can never buy a stock below the zero RS line, or that you can never short a stock above the zero line. If the relative strength is in good shape and improving, and all other criteria are positive, then go for it. But absolutely never buy a stock, no matter how good the other factors, if the relative strength is in negative territory and it remains in poor shape. Now let's look at some real-world examples of relative strength in action. First, go back to chart 413 of Merck. Once it broke out above 60 in late 1985, the relative strength really did its thing. In fact, even before the breakout, relative strength was trending higher, which was a positive sign. Then, after MRK broke out above 60, it moved into positive territory and continued to strengthen throughout 1986 and the first half of 1987. It's no surprise that Merck's price tripled, making it one of the biggest of the blue chip winners of that period. Charts 414 and 415 demonstrate the merits of relative strength charting. Adams-Russell, chart 414, staged a major breakout in early 1986 as it broke out above resistance at 15. The volume was impressive, and once it moved above 16, there was no further overhead supply on the long-range perspective. Prior to the breakout, relative strength had only been so-so. But in the few weeks before it broke out, it started advancing nicely. When the breakout occurred, the RS graph moved above the zero line. With all of our buy criteria fulfilled, it was not shocking that AAR came close to tripling in the next year and a half. Alpine Group, 415, broke out above 5.50 in early 1986. Volume expanded sharply. Resistance was non-existent on the long-range perspective, and the RS line was in good shape. Even though it was below the zero line before the breakout, the RS line was trending higher for 90 days prior to the breakout. When the stock moved above 5, the RS line moved above the zero line, a second favorable relative strength signal. The stock followed the game plan very nicely as it quadrupled over the next year and a half. Now let's look at the reverse side of the coin, those breakouts which are not accompanied by positive relative strength. Once in a while, such mediocre breakouts will turn into big winners, but don't worry about that. Our game plan is to look for the 80 to 90% favorable probabilities, not the long shots. We'll leave them to the horse players. Chart 416 shows what inferior relative strength looks like. Even though XYZ is trending sideways in a 50 to 55 trading range, the RS line is telling us to look out below. It is trending lower, showing that the stock is acting far weaker than the overall market. It's therefore very likely that the eventual breakout from this neutral range will be on the downside. Even in the rare case where the stock ends up popping out on the upside, it's not worth buying since its advancing action will very likely be only mediocre. Here's what I'm talking about. Acme United Corporation on chart 417 broke out on the upside in early 1987 at 8.50, point B. The RS line, however, was warning you not to buy the breakout. Here's why. First, the RS line was deep in negative territory, well below the zero line. That doesn't automatically exclude the stock from buying considerations, but it's a red flag. The stock's RS line had better be putting on a decent show of strength, or forget it. This was a case of forget it. ACU already had 2 strikes against it. Strike 2 was the RS line, which was in a major 12-month downtrend since its early 1986 peak. Strike 3 was signaled when ACU broke out at point B and the RS line was lower than it was at point A, even though the price line was higher. That should have been the end of any consideration about buying it. But to further tempt the unwary, the stock broke out again a few months later at 9.125 point C. Again, the RS line was lower than at its prior peak. C was lower than B on the RS line. The end result was that instead of moving higher with the rapidly rising Dow, Acme actually declined. This same losing pattern showed up in Care Enterprises, 418. In early 1987, Care broke out at 4.25 point B. Once again, the RS line was in poor shape. It was in a major downtrend, in negative territory and lower at point B in the breakout than at point A. It's not surprising that the stock then fell by 50%, even though the market averages moved higher. Finally, chart 419 cinches the case. Grand Auto had a relative strength line that needed Geritol. The breakout point B had very poor relative strength point B below A. The RS line was below the zero line, and the stock was in a downtrend. Another warning to pass on this breakout was the lack of volume confirmation. Grand Auto then reversed and dropped 40% in a rising market. So the lesson is clear. Overlook the message of relative strength at your own peril. We want the very best buy candidates, not the also-rans. Relative strength helps you zero in on tomorrow's big winners today. Quick reference guide on buying. Before going further, here's a handy checklist that will do 2 things for you. First, it will act as a quick review of the very important steps we've covered in the buying section. Second, it will serve as a future reference guide to the proper sequence to use when looking for new buy candidates. Check the major trend of the overall market. Uncover the few groups that look best technically. Make a list of those stocks in the favorable groups that have bullish patterns but are now in trading ranges. Write down the price that each would need to break out. Narrow down the list. Discard those that have overhead resistance nearby. Narrow the list further by checking relative strength. Put in your buy stop orders for half of your position for those few stocks that meet our buying criteria. Use buy stop orders on a good till canceled GTC basis. If volume is favorable on the breakout and contracts on the decline, buy your other half position on a pullback toward the initial breakout. If the volume pattern is negative, not high enough on breakout, sell the stock on the first rally. If it fails to rally and falls back below the breakout point, immediately dump it. Further tips for buying. The steps that I've already covered in the buying process are crucial. On a scale of 1 to 10, with 10 being the most important, they are 10s. If you follow them faithfully, you are going to be very pleasantly surprised. I now want to teach you a few more refinements. They aren't as important, but they can raise your profits to an even higher level. When you read most books on technical analysis, you are quickly introduced to all sorts of exotic and confusing formations. Suddenly, you are thrust into a world of triangles, pennants, and flags. I'm not saying there isn't merit to these fancy formations, but they aren't crucial to your scoring big profits in the market. I promised you at the beginning of this book that I'd only deal with the most important technical indicators. So forget about saucer bottoms and flying wedges and what have you. Nevertheless, there are a few formations you should be familiar with. These are both easy to spot and very profitable. The first one is the head and shoulder bottom formation. This is the most powerful and reliable of all bottom formations. Most investors have heard of it, but few really know one when they see it. In fact, novice technicians usually imagine them on every other page of a chart book, just as a first-year medical student often worries that he has contracted every disease that he studies. This dynamic pattern appears after a stock has suffered a major decline and is ready to reverse sharply to the upside. Chart 420 shows what to expect as this pattern unfolds. First, there is a decline that drops XYZ to a new low, followed by an oversold rally point, A. The left shoulder has just formed, but it is too early for you to know that at this time. Next, there is a smash that drops the stock to yet another new stage for low. But now comes the first sign of budding strength. Once the urgent selling pressure runs its course, XYZ surprisingly rallies very close to the same resistance level as last time, point B. The head has just formed on what is very unusual and bullish action. Up until now, rallies that started after a new low was registered failed far below prior peaks. So although it's still too early to buy, you get the feeling that something is going on. Next, there is another decline that gets underway, but it doesn't drop the stock to a new low. In fact, it doesn't even take XYZ all the way back to the last low, which is another subtle sign of strength. Ideally, the rally peaks points A and B will be at the same approximate price, and the two sell-offs on each side of the reverse head will be approximately equal. But don't be a fanatic. Both the peaks and the two sell-offs can be off a bit. Just be sure that there is some semblance of symmetry. After this sell-off ends and the stock starts to rally once again, the right shoulder is completed. One other thing to be aware of is that points A and B on the chart, the first two peaks, should be connected with a trend line that is called the neckline. Keep a close eye on the neckline, because if the stock breaks out above it, a bullish signal will be given. As for volume, on the head and shoulder bottom there are all sorts of fancy theories. Most theories view this scenario as bullish, volume heaviest on the left shoulder, somewhat lighter as the head forms, and contracting as the right shoulder forms. But forget about volume in the formation. After studying literally thousands of such reversal patterns, I've come to the conclusion that volume is not a good indicator of future upside potential for head and shoulder bottoms. There are two signals that are important and very reliable. Both are from our system, and neither must ever be ignored. First, make sure that the 30-week MA is in fine shape. It should no longer be declining, and the stock should not still be below it after it breaks out above resistance. If the MA is declining, don't buy the stock even if it breaks above the neckline, and even if it moves above the MA. If the MA later stops declining, you can buy the stock on a pullback toward it. If the stock is still below the MA after it moves above the neckline, don't buy it until it also clears the MA. The second important signal is volume after the stock breaks out above the neckline and the MA. While you shouldn't spend a lot of time worrying about volume as the head and shoulder bottom is forming, you should worry plenty about what happens afterwards. The same volume rules that we went over earlier still hold. There must be a significant increase in volume on the breakout, or it isn't trustworthy. Head and shoulder bottom patterns are definitely easier to spot on a daily chart than on a weekly graph. Look at Unocal first on the daily graphs chart for 21, then on the Mansfield weekly chart for 22, and you'll see what I mean. Nevertheless, the really powerful patterns can be picked up even on the weekly chart. Let's start practicing so you'll soon be sharp enough to spot them. First, look at Unocal on weekly chart for 22. Once it moved above the neckline at 24.875, it was a solid buy. Volume confirmed and relative strength was improving, so the big advance in the coming months was predictable. Now look at chart 423, which shows a head and shoulder bottom pattern forming over a 1-year period. Usually they will take shape much faster, but this makes it no less valid. Let's follow the zigs and zags closely because they are instructive. First, ASA dropped to a low at 32 in late 1985 before rallying back close to 41. The reverse left shoulder was now in place. Now another more powerful decline set in that took ASA all the way down to 28. However, instead of staging a mediocre rally, the stock took off sharply on the upside. Where did it rally to? Right to the vicinity of the last peak, as this push failed at 41.50. The reverse head was now in place. The fact that ASA could break to a new low and then power back slightly above its last rally peak was an important signal that aggressive buyers were starting to return to the stock, but there was still a bit more work to do. The ensuing decline took ASA to 34.375, which was about 2 points higher than the bottom registered on the left shoulder. Once the next rally started, the right shoulder was set. Next, the two rally peaks points A and B are connected to form the neckline. Now it's time to wait and watch. When ASA moved above the neckline at 42.50, your buy stop order was executed. Volume picked up on the breakout, which was encouraging. Relative strength improved sharply within the few weeks before and right after the breakout, which was an added plus. And finally, although resistance still started in the mid-40s, it was close to 2 years old, which made it far less potent. With all of our fail-safe systems in place, it was okay to buy your other half position. While you can't easily see it on the weekly chart, ASA quickly moved above 44, then pulled back close to 42 where additional buying should have been done. The stock then moved up to 49 before dropping back to 46, which was the last chance to buy ASA before it rocketed up to 73.50. ARA Services, for 24, provides additional insight into the wonders of the head and shoulder bottom. Study it for a moment, and you'll see the same favorable picture taking shape. First, there was a drop to a new reaction low near 24. The left shoulder formed as ARA rallied back to 30. Then in early 1982, the stock plunged to a new stage for low near 22. Thereafter, the buyers moved in, once again taking prices back up close to the prior peak. The head took shape and the neckline formed. ARA then dove to 25 as it held well above the prior low. Now, an interesting phenomenon occurred that you should be aware of. The stock again rallied back close to 29 but didn't break out. After that, it quickly dropped below 26 before starting another rally. Thus, there were two right shoulders. This is not unusual and in no way diminished the bullish implications of the pattern. Technical purists demand two shoulders on the left side if there are two on the right side. I disagree. Such symmetry isn't important as long as the necessary criteria are met. Anyway, ARA was an excellent buy at 30 once it broke above its neckline. It was also helped out by impressive volume and excellent relative strength. Are you starting to see what to look for? It's important to get used to spotting valid stage 1 head and shoulder bottoms because these are powerful patterns. They don't form nearly as often as amateur technicians believe, but when they do occur, you should definitely ride them. Now study charts 425 and 426 of Sunshine Mining and TRW. They will help you train your eyes for this profitable formation. One last thing you should be aware of is that the head and shoulders bottom can also be an indicator for the general market or for a group. Here's what I mean. While an isolated formation or two doesn't have any significance for the market, several such patterns forming in the same time span does. For instance, in late 1974 and again in mid-1982, there were plenty such formations. This was a bullish indicator for the overall market. Those of you who remember your market history know that in both instances major bull markets began. In the same vein, several such patterns forming in one group is a very bullish signal for that sector. A perfect example of this was seen in 1986. Several oil-related stocks, oils, drillers, and oil service stocks, completed head and shoulder bottoms before the group turned out to be one of the big winners in 1987. Double-barreled action. While the next formation that I'm going to teach isn't as dynamic as the head and shoulder bottom pattern, it is a very profitable one. This is especially true when it occurs in conjunction with impressive volume, favorable relative strength, and minimal overhead resistance. As you can see from chart 427, stock XYZ should first hit a low point A, then bounce higher once the selling pressure lessens. And a second wave of selling develops, which brings XYZ all the way back down to its prior low point B. It's a favorable sign if the renewed selling pressure cannot ignite a significant new down leg in the stock. It doesn't matter if there is a marginal new low with B dropping slightly below point A. The important thing to watch for is that on the next rally the stock snaps back toward the recent peak. The breakout can occur immediately thereafter, or in some cases, the stock may consolidate for several weeks before breaking out above resistance and moving into stage 2. Whatever shape the bottom takes, do not anticipate. Don't buy prematurely. In some cases, the breakout never occurs and the stock plummets to a new low. At other times, the breakout may come many months later, and by then, you'll have become frustrated and sold the stock. It's common for this pattern to form within a matter of weeks, as it did with Anchor Glass Container chart 428 and Sun Microsystems chart 429. However, in a smaller percentage of cases, it can form over a very long period of time, as Harvard Industries did chart 430. Take a moment to look at each of these 3 case histories. In the case of Anchor Glass Container 428, the stock dropped close to 10.A before rallying to 14.125. A second wave of selling then took the stock back to 10.50 late in 1986. A slow rally then got underway, with volume starting to increase, a favorable sign. However, after reaching 13.50, that rally also failed to clear the important 14.125 resistance, and a further consolidation took place during the following weeks. Then, once the stock had moved both above its trend line and above the 14.125 resistance, the Stage 2 advance was underway. In the case of Sun Microsystems 429, the double bottom formed very quickly. Once it moved above resistance at 15.25, it was ready to go into orbit. Note that the relative strength increased nicely at that point as the stock moved into positive territory. In addition, volume was very impressive. Finally, once the 20 level was overcome, there was no further overhead resistance. As for Harvard Industries 430, the double bottom formed over a 15-month period, but once the bottom formation was completed and the stock moved above resistance at 8, the results were the same as with Anchor Glass and Sun Microsystems. You should also be on the lookout for these formations in the market averages. In late 1974, chart 431, after the worst bear market since 1929 to 1932, a powerful double bottom appeared in the Dow Jones Industrial Average. After declining to point B, the next rally moved the blue chip average above the downtrend line and the 30-week MA. The 1975-76 bull market was underway. Be very careful when dealing with double bottoms because they form frequently, whereas valid head and shoulder bottoms are few and far between. Be very demanding and make sure all of the criteria we've gone over in the past few sections are met so you don't end up buying B and C double bottoms. Bigger is better. There's an old saying among technicians, the bigger the base, the bigger the move, the corollary being, the bigger the top, the bigger the drop. I heartily subscribe to that statement. While there are plenty of cases where short-term bases, when mixed with all the other winning ingredients, produce excellent results, always be on the lookout for a breakout from a very large base formation. This is especially important since these formations usually lead to very extensive and long-running advances. Intuitively, this theory makes a lot of sense. Just as a big house needs a very strong foundation, so too, a large base can propel a stock higher over an extended period of time. It also makes sense in technical terms. What a big base really means is that a lot of stock has changed hands during the Stage 1 formation. Many disenchanted sellers who were holding the stock as it plummeted, hoping to get out even, finally sold the stock in disgust to a new group of buyers at this low price. This cuts down the amount of resistance that is overhead. Many of the former potential sellers who were disgusted and wanted to get out even have now dumped their stock. The new holders are willing to be far more patient and wait for the stock to advance significantly before selling. Here are two examples of what you should be looking for. American Barrick Resources, 432, broke out above resistance near 4 in early 1986 and advanced almost 400% over the next 15 months. All of the factors I've been stressing were in place. There was a long base pattern that was completed when ABX moved above resistance. Volume was not only impressive on the breakout, but had been building up in the prior several weeks. In addition, there was no nearby resistance, and the RS line moved into positive territory on the breakout. The same winning combination was evident in Korea Fund, 433, in 1986. When KF moved above resistance at 18, it signaled that it had completed its long-term base and was ready for a substantial advance. The move up to 86 over the next year and a half was that substantial advance. Once again, volume, relative strength, and the lack of nearby resistance were all textbook perfect. We've come a long way in the past few chapters, so let's stop and reflect on what we've learned. By now, you should realize that winning in the market is a matter of discipline and being able to spot patterns which time and again have correlated with big winners. You should also realize that the more of these favorable patterns we tie together, the more likely we are to win, and the bigger our gain will be. Stands don't commandments. Now that you are familiar with when and what to buy, here's a checklist of when and what not to buy. Although the list is short, it is very deep in wisdom. If you thoroughly learn it and make sure to never violate any of these rules in the future, you are going to find your experiences in the market much more fun and profitable. Don't buy when the overall market trend is bearish. Don't buy a stock in a negative group. Don't buy a stock below its 30-week MA. Don't buy a stock that has a declining 30-week MA, even if the stock is above the MA. No matter how bullish a stock is, don't buy it too late in an advance when it is far above the ideal entry point. Don't buy a stock that has poor volume characteristics on the breakout. If you bought it because you had a buy stop order in, sell it quickly. Don't buy a stock showing poor relative strength. Don't buy a stock that has heavy nearby overhead resistance. Don't guess a bottom. What looks like a bargain can turn out to be a very expensive stage for disaster. Instead, buy on breakouts above resistance. Don't put all your eggs in one basket. Now that you know what to buy and what not to buy, there is one last topic to cover: diversification. No matter how expert you become with my system, don't ever expect to achieve perfection. The future is too uncertain. It is feasible to be right a very high percentage of the time, but that implies being wrong now and then. Prudence dictates that you spread your risks over a number of stocks. That prevents one unfortunate choice from dealing you a crippling blow. Even when protecting your long positions with sell stops, which I'll teach you how to do in Chapter 6, you can get hurt badly if you don't diversify. If you lose 15% on a position to which you have committed your entire market stake, that puts quite a crimp in your wallet. And if you're unlucky and hit a second 15% whipsaw, your capital is badly depleted. But if you have your money equally distributed in 15 positions and one loses 15%, that loss represents only 1% of your market capital. A perfect example of the market law of averages was exhibited in early 1987 in the Professional Tape Reader. 3 of the buy recommendations I made in early January of that year were Dravo Chart 434, Tandem Computers Chart 435, and Texas Instruments. Dravo moved to a new multi-year high when it broke out above resistance at 20.A. Unfortunately, it made little headway and was stopped out when it broke below major support at 18. At the same time, Tandem Computers quickly came close to doubling from our recommended price of 19.875.A. Texas Instruments also turned in an A+ performance, although it took a bit longer to almost double from our recommended price of 41.875. If all of your capital had been in Dravo, the powerful market advance that started in early 1987 would have been a disappointment to you. By diversifying your money among these three holdings, you would have walked away smiling. Many who attend my seminars ask, what is the right number of stocks to hold in my portfolio? Is it 8, 10, or 12? The answer: there is no single magic number, but there is an approximate area which makes sense to me. I know that 1 or 2 stocks is far too dangerous an allocation of capital. I also believe that 40 to 50 stocks are far too many issues to keep track of. Keeping a watchful eye properly focused on your portfolio is a lot like being a parent. The more children you are responsible for, the harder it is to keep close tabs on them. So too with stocks. If your market assets are allocated among 50 stocks, it is very difficult to get a feel for how each one is acting. In addition, there is the tendency to concentrate on the issues that are acting well and put aside your concern about the laggards, figuring they will come to life later. What happens is that you let the good stocks subsidize the bad ones. The proper way to look at your stocks is to make believe that each position is the only one you have. If it's acting fine, great, ride with it. But if it's lagging badly and acting poorly, lighten up on that position even if the sell stop isn't hit. Move the proceeds into a new Stage 2 stock with greater promise. To be more specific, for a small portfolio that's investing a modest amount, $10,000 to $25,000, I diversify into no more than 5 or 6 stocks. But as you move up the ladder into 6-digit or higher portfolios, 10 to 20 stocks are the most that I'd invest in at any one time. Also, use approximately equal dollar amounts when constructing your portfolio. Don't do as so many investors do who think in terms of the number of shares they can purchase. They buy 1,000 shares of everything, whether it's a $5 or $40 stock. To use a nice round number, if we were investing $100,000 in 10 stocks, each position should be approximately $10,000 in value. So if you are buying a $50 stock, you will purchase only 200 shares. If a second position is a $10 stock, you'll enter a buy order for 1,000 shares. Common sense should be applied when constructing your portfolio. Don't put all your eggs in one basket, but don't go to the other extreme of using too many baskets. There is one other form of diversification to be aware of and practice. Don't do all of your buying from just one group. If 3 or 4 sectors exhibit great technical action, buy Stage 2 breakouts from all of them rather than from only Group A. If one group suddenly reverses, your portfolio will still do well. If you practice these 2 forms of diversification and properly utilize my system, you should do very well in the market year in and year out. Chapter 5. Uncovering Exceptional Winners. Have you ever dreamt of buying a stock today, then going to sleep and waking up tomorrow to the exhilarating news that the company is being taken over at a substantially higher price? In this chapter, I am going to show you how to make this dream come true at least occasionally. In addition, you'll learn about a little-known technical method I've developed that can produce profits as startling as takeovers. First, let's examine the takeover dream which, for most investors, leads to financial nightmares. I've seen investors buy on rumor after rumor and have not one deal pan out. Some terrible losses can pile up while they wait for the announcement that never comes. Why do so many investors chase these rainbows? It's a simple study in psychology. First, there's greed. We all want to hit that big gusher in a hurry, so we dream that maybe this time our ship will come in. Second, there's a theory in psychology called intermittent reinforcement. It says that if an animal gets what it wants, even in a small percentage of the cases, it will keep coming back for more. It's been demonstrated time and again that if a mouse gets cheese just once when going through a maze, it will try to navigate that maze over and over again, even when the cheese is no longer there. People aren't that different from animals. Why else would we play the slot machines in Las Vegas or try to win a lottery? All it takes is one jackpot going off in the casino or one lottery winner in the headlines and we start dreaming again. As long as you keep this long-shot syndrome in control and do no more than put a few coins in a slot machine or buy an occasional lottery ticket, this all-too-human trait is no big deal. But if it drives you to continually buy rumor stocks, then it's a very serious problem. It will cost you dearly, because for every one rumor that turns out to be true, hundreds end in stage 4 downtrends. Those aren't winning odds. And yet more and more stocks are being gobbled up as takeover mania becomes ever more popular. Is there a way to intelligently play this game? Yes, and once again the disciplined answer is in the charts. Simply do the following. First, only play this game with a small percentage of your capital. The great majority of your buys should come from your studies. Second, if you hear a rumor, judge the source. If it's your stockbroker and a few of his prior recommendations have actually worked out, that's a better source than if your broker has never had a bullseye in his life. But don't stop there. Now comes the discipline. Get out your charts and study the stock carefully. If the stock looks like Beverly Enterprises did in mid-1987, chart 5-1, then forget it, even though there were takeover rumors surrounding it. If the stock is in stage 4 and the relative strength is a horror show, walk away from that slot machine right then and there. Or if the chart is bullish but so far above its ideal entry point as anchor glass container, chart 5-2, was in mid-1987 near 28, then forget it. I'd rather miss out on a potential profit any day than buy a stock with a poor reward-risk ratio. All you've lost when you miss a winner is a potential profit. Like buses, another one will come along. But what you've lost when you get broadsided by a losing situation is a portion of your very precious capital. Here a bit of mathematics comes into play. If you have $50,000 invested and you lose 20%, you are now reduced to a $40,000 market stake. To get back to even, you now need a 25% gain on your next trade. And if this trade is a loser, then the percentages move even further against you. So discipline and selectivity are operative words to always keep in mind. Remember, we can make really big money in the market even if we pass up 100 winners and buy only 10 stocks during the year, with 7 or 8 turning out to be winners. But what if the chart of the rumored stock looks bullish and it hasn't broken out yet? Or if it has already moved above resistance, but is still close to the ideal entry point? If all the factors are favorable and you would honestly consider buying it even without the rumor, then it's worth a shot. The takeover possibility is simply icing on the cake. This was the case with KID chart 5-3 in mid-1987. The stock was a valid buy as it moved above 37 on huge volume, rumor or no rumor. Volume was impressive, relative strength was improving, and there was no further overhead resistance. A few weeks later, that buy looked even better as the stock hit 67.25 on the news that Hansen Industries was taking over KDE. Just remember that the same chart rules still apply. If the volume or any other important factor is negative, then pass on it. When it comes to spotting takeovers, there is one telltale clue to always look for, and that's volume. This is especially true if the takeover is going to be announced within the next few weeks. In almost every case where a merger is imminent, volume builds to an incredible crescendo. This makes sense, since more and more people find out about a takeover as it nears completion. Even though nobody is ever supposed to pass along inside information, it does happen. The charts show time after time that some people do know and are buying on that knowledge. So never believe in any potential takeover that doesn't show a very significant increase in volume. Now let's examine several other real-life examples of stocks that were taken over so that you'll know exactly what to look for. Study chart 5-4 of Hammermill paper. Back in mid-1986, there were rumors that it was a possible takeover target. But what if you had never heard any stories about the stock? Simply based on the rules I've taught you, this was a solid buy candidate as it moved above 45. The market trend was in fine shape. In addition, the group was positive, with several other stocks in the sector also bullish. Furthermore, relative strength was positive and improving rapidly. Another favorable factor was that once it broke out above resistance at 45, there was no further overhead supply. And most important, the volume pattern looked great. Carefully scrutinize the volume for a moment, because it's the key to spotting takeovers. Not only was it high on the breakout, which is a bullish sign, but there was also a steady increase in volume in the prior 8 weeks. That was the real clincher. Even if you hadn't heard any stories about HML, it was a continuation by that you should have strongly considered. HML zoomed from 45.125 to 65 during the next 5 weeks following the breakout and was then taken over by international paper. Chesapeake Pond's chart 5.5 displayed the same winning pattern in early 1987. Again, all of the technical factors were in place for a big winner whether or not your broker had any tales to tell you. The market trend was bullish, the group positive, there was no significant overhead resistance, and the relative strength was excellent. The coup de grace was the volume build-up. When the stock broke out, volume registered its highest one-week reading on the chart. Therefore, whether or not you heard anybody whispering about the stock, Chesapeake should have been bought. Every technical sign that you could ask for was flashing by, and the stock complied nicely by racing quickly from 50 to over 72. Is the pattern starting to become clearer to you? Even if you'd heard nothing about the stock, the chart would have been the tipster that something was brewing. And if no takeover was in the works, then something else positive was happening, and the probabilities were great that it would have rocketed higher anyway. Let's put another case history under the microscope and follow it step by step. In late 1986, Burlington Industries, chart 5.6, was already in a powerful stage 2 uptrend when it broke out above resistance near 40. All factors were positive, and the stock merited buying as a continuation breakout. Volume, however, was not spectacular. It merely fulfilled its 2 times criteria, and the stock worked its way higher in the following weeks. In early April 1987, however, something exciting was beginning to take shape. Rumors about BUR were making the rounds, and the stock broke out above resistance at 50 on unbelievably heavy volume. If you already had purchased Burlington, this was a reason to buy more. If you didn't own any, this action warranted some buying. The stock jumped from 50 to 77.50 over the next few months. Again, the heavy volume was the tip-off that a merger was in the works. If, after studying these case histories, you really believe that no insiders act upon their knowledge before merger news is announced, then you are far less cynical than I. Here are 2 more case histories of stocks that had a takeover pattern before the merger news was publicly announced. In the case of Fruhoff, chart 5.7, the stage 1 base was very large, resistance wasn't heavy, and relative strength was improving nicely. Most important of all, the trading activity showed the classic pattern of increasing volume that we want to see. Therefore, when it broke out above 27 in early 1986, it should have been bought, whether or not you heard any stories. Such buying paid off as FTR quickly ran up close to 50. In the same manner, Purolator Courier, chart 5.8, was an exciting purchase that paid off handsomely if you followed the technical rules for uncovering a big winner. When it broke above its downtrend line at 20.125 in late 1986, relative strength was improving nicely as it moved above the zero line. In addition, dramatically increased volume indicated there was a good chance that resistance near 24 would be taken out. This turned out to be the case as the stock zoomed toward the 40 level. By now, it should be obvious what things you must be alert to when looking for takeover targets. No amount of gossip or rumor can make up for a negative stage for patterns such as Financial Corp. of America, chart 5.9 in 1987. Yet if I had heard a good story on a stock with a strong technical pattern, such as Safeway Stores, chart 5.10, in 1986, I would most definitely have put it down on my potential shopping list of buys. Then when it broke out above 40 with positive relative strength, no further overhead supply, and a sharp volume increase, I would have rated the stock a strong buy candidate, takeover or not. As it turned out, it was taken over, as was every stock that I've shown you so far in this chapter, except for the 2 negative charts of Beverly Enterprises and Financial Corporation. So follow these rules and you'll be amazed how often you end up buying what the insiders buy, without knowing the information that they are privy to. This is exactly what occurred when I recommended stocks such as Caesars World, Owens Illinois, Piedmont Aviation, and Spectradyne, charts 5.11 through 5.14, in the professional tape reader. All became takeover targets, along with several other recommendations, and moved substantially higher in the months ahead. While I'm sure some PTR readers thought I had heard a good story on these stocks, the simple reality is that I read the message of the tape. From now on, you will be able to do the same. The triple confirmation pattern. There is a second pattern to look for that also produces outstanding profits. It has nothing to do with takeover candidates, unless by coincidence. The results, however, are equally spectacular and, in some cases, even more profitable than a merger stock. I discovered this technique long ago and introduced it in the professional tape reader back in the mid-1970s. Be aware that while this formation produces some unbelievable winners, it is not for short-term trading. Rather, it is a method whereby aggressive investors can uncover potential big winners to ride for a major advance. In football, a player who is a triple threat can run, pass, and kick. It is very rare to find someone who is outstanding at all three. This pattern also occurs only occasionally with stocks, as it requires the unlikely to happen. 3 different favorable signals must be flashed in close proximity to each other. In addition to the basic requirements of the stock being above the MA, the following 3 events must take place. First, there must be a volume signal. This is vital. The market champs almost always have substantially larger volume on the breakout than during any point in the stage 1 base area. For this type of big winner, we want to see volume of even more than twice the average trading of the past 4 weeks. In addition, the heavy volume should not be short-lived. The initial volume surge should be followed by several more weeks of heavy trading. This signal indicates a sudden tremendous interest in the stock, as well as additional future demand. Since the stock is starting to run away on the upside, buyers will be fast to add to positions on any corrections. When the dips are too shallow to accommodate their buying, these buyers will often get into a buying panic. Once again, very impressive volume A on chart 515 is the key ingredient to a super winner, but it's not the only one. The second factor to focus on is relative strength, B on chart 515. This is a very important tool to use in distinguishing good from great buys. For this triple threat pattern, the RS line must be in a certain position. It should either be in negative territory or hugging the 0 line in a neutral manner. Then, as the stage 2 breakout occurs, the RS line should move decisively into positive territory. This is very important. I've shown that you can buy stocks which have an RS line in negative territory as long as it is improving and all of the other technical factors are positive. But when looking for this very special big winner pattern, there can be no compromises. If relative strength remains in negative territory, it doesn't fulfill this special criteria, even though the stock can still be a good buy and can chalk up a fine gain. The third clue to look for is a big move before the stock breaks out. I know it sounds strange since we all want to buy as cheaply as possible, but this is an important element of this aggressive big payoff pattern. If a stock has wide swings while still in its stage 1 base pattern, then it's far more likely to be a ball of fire once it breaks out. Just as a high jumper gets into a low crouch before taking off upward, a stock that first dips and then gets up a good head of steam will be far more powerful once it leaves the starting gate. As a rule of thumb, stocks that have risen some 40 to 50% or more before breaking out do the best in the months ahead. But this does add some near-term risk to the breakout, which is why I stressed earlier that this kind of buying is strictly for investors rather than traders. Back in 1971, Anthony Industries fulfilled all of the necessary criteria perfectly. Volume expanded by about 4 times normal levels, a definite sign of important buying interest. A. On chart 516. Furthermore, volume remained heavy in the following weeks. The RS line also moved decisively into positive territory, B on chart 516. The third significant clue that a big payday was shaping up was the volatile action that Anthony Industries displayed while it was still in its stage 1 base. It swung back and forth between support at 5 and resistance at 10. Therefore, when it first broke out at 10.125 in late 1971, point D on chart 516, it had already advanced 100%, To many investors, this was a time to do selling since the stock was overbought. But now that I've trained your eye and you are starting to develop a feel for charts, you should view the situation differently from the average investor. At point D, Anthony was first moving into stage 2 on heavy volume. So instead of joining the crowd with conventional terms such as overbought and overvalued, you should have said only one word: buy. Over the next 8 months, our big winner theory became reality as Anthony advanced over 300%. National Semiconductor, chart 517, demonstrated this same big winner potential back in 1973. Since the overall market averages had already turned negative, you should not have been looking to do much buying. Rather, you should have had plenty of short sales working for you during that bear market. If, however, you came across one outstanding buy pattern such as National Semiconductor, you could have hedged your shorts with one excellent buy candidate such as this. But you better have made sure it was an A+, because there is no room for anything less when the overall market trend is negative. National Semiconductor was such an A+. It was a three-way winner as volume increased impressively by almost 3 times the average of the prior few weeks, on chart 517. In addition, volume remained at a very heavy level in the following weeks after the breakout. Relative strength was close to the zero line before the stage 2 breakout. Thereafter it moved quickly and strongly into positive territory. The third important signal that a big advance was shaping up was the big move National Semiconductor staged before the stage 2 breakout took place. The stock came close to doubling as it moved from near 20 to 40 before breaking out at point D at 40.50. Again, many thought the stock was too high after such a sharp advance, but you know better. To see how powerful this triple confirmation pattern can be, National Semiconductor rocketed ahead over 150% within the next 3 months, an incredible 600% annualized advance. This is a fabulous move anytime, but it's especially impressive coming in the midst of the 1973 to 1974 bear market. So always be alert for this formation, because when you spot it, you want to fully exploit it. To make sure you've got this important concept down pat, let's look at a few more examples of this very profitable phenomenon. In early 1987, volume increased sharply in Blocker Energy, chart 518, as it broke out of its stage 1 base pattern at 1.125. Not only did volume easily exceed the average of the prior weeks by more than twice, it was more than 5 times heavier. Such a sharp increase in volume shows that big money is becoming interested in a situation, and it almost always forecasts a significant advance. Blocker was no exception. Again, it was as easy as ABC to uncover this big winner. While the fundamentals were none too enticing and the red ink was plentiful, the telltale technical clues were there. In addition to the group being very bullish, there was only limited overhead supply to worry about, and that resistance was about 1.5 years old. Furthermore, the stage 1 base was very large. On top of all these bullish signs, all 3 of our big winner factors were in place. Volume was excellent on the stage 2 breakout, showing that there was plenty of propulsion behind this potential winner. Second, relative strength had been hovering near the zero line slightly in positive territory. Once the breakout took place, there was no more. The RS line took off like a shot from the neutral zero line. Finally, although the low price disguises it, there was one heck of an advance before the breakout occurred. Blocker moved from its low at 0.375 to 1.125 as it broke out, a hefty 200% advance. But the predictable fun was just getting underway, as Blocker chalked up a 600% gain in the following 11 months. Are these just a few lucky shots in the dark? No way. While these patterns don't pop up every day, or even every week, they do form periodically. As you become more skilled in reading the charts, you will pick out these patterns and ride them for all they are worth, which will be plenty. Both Keystone Consolidated and Philippine Long-Distance Telephone, charts 519 and 520, fulfilled all 3 requirements of my big winner technique. Again, the results were fabulous. Interestingly enough, when the up move in Keystone started at 4.625, The latest 12-month trailing earnings were a deficit of $3.70 per share, with many P&E watchers worrying that the company was on the road to bankruptcy. And after the jet-propelled advance up to 30, what do you think the earnings had improved to? As of mid-1987, with the stock up to 30, the cumulative earnings for the prior 12 months were a rousing deficit of $1.16. The earnings still hadn't moved into the black. So much for fundamental analysis and price and earnings ratios. As for the activity within the base, it met our 40% or more criterion, although it is hard to tell from this chart. One of the few weaknesses of the Mansfield chart is that it is an arithmetic scale rather than a logarithmic or percentage scale. When a low-priced stock advances sharply, the low-priced action looks minuscule even though the percentages are large. When you find one of these special big winner patterns, invest much more heavily in it because the probabilities are great that you have a grand slam home run on your hands. Once you've mastered the concepts of this very important chapter, you'll know how to uncover those special situations that make investing so much more rewarding than savings bonds. And you'll know the right time to hop aboard.
Hey traders, big thanks for tuning in and listening to this audiobook here on Trading for Life. Your support keeps this channel alive and growing. If you found value in what you heard today, smash that like button, share it with your fellow traders, and hit that subscribe button so you never miss our future uploads. Let's keep learning, growing, and trading smarter together.